Hello students, this is Professor Niyati Ashar from JK classes, and today we are here to discuss May 2022's RTP of paper number 5, that is your advance accounts. What are we going to discuss here? We are going to discuss all the questions and the solution. All the entries will be taken care of and each and every theory question shall also be discussed. So let us get started with our questions. Yes? Now, in RTP, they will give you all the chapters over here, and from each chapter they will give you 1 or 2 questions. This will help you to revise the entire chapter. Now, the first question is given of partnership firm, dissolution of partnership chapter. Let us read the question. The firm of Mrs. Ohm has 4 partners, A, B, C and D. And as of 31st March 21, its balance sheet stood as follows. They have few assets, namely land, building, office equipment, computers, data and stock. Yes. After that, they have cash and bank and other current assets. Again, sundry asset, one of the sundry asset. Current account of Mr. D is given 87,400. But when current account is given, it means that capitals are fixed. Yes. Okay. Capital accounts of Mr. A, B and C are 2 lakh, 2 lakh and 1 lakh respectively. Current accounts of A, B and C are again 50, 150 and 110 respectively. Outside liabilities are loan from NBFC 5 lakhs and current liabilities of 70,000. The partners have been sharing profits and losses in the ratio of 4:4:1:1. Their PSR is given. It has been agreed to dissolve the firm on 1st April 2021 on the basis of the following understanding. Your balance sheet is as on 31st March 2021 and on the next day we are going to dissolve the firm. While dissolving, which all accounts do we prepare? We need our realization account, we need our cash account, we need our partner's capital account, and here specifically current account is also demanded. So we are going to prepare all these 4 accounts. See bacha, last line. Show cash account, realization account, partner's capital account including their current accounts. So step number 1 says that all the balance sheet items should be transferred to the respective accounts at book value. We'll be doing that. Let us see the solution. I have transferred all my sundry assets, land, building, office equipment, computer, data, stock and other current assets to realization account on the debit side. Your outside liabilities are current liabilities and loan from NBFC. What other balances do you have? You had your cash balance. So cash opening balance is given over here, 75,000. Other than that, you have your capital balances. Now, partners' capital accounts were 2 lakh, 2 lakh and 1 lakh. Coming to your current account, Mr. D had debit balance over here of 87,400 and the remaining partners had credit balance. So, to balance brought down 87,400 and for the rest of them it will be by balance brought down. Are we good till here? Yes. Further, the following assets are to be adjusted. I am on adjustment A. The following assets are to be adjusted to the extent indicated with respect to their book values. Beta, these are the realized values of all your asset. After transferring all the balance sheet items to the respective accounts at book value, the next step is that sell off all the assets and from the money received, pay off all your outside liabilities first. Now, in order to sell the assets, what are the values given? Land is to be valued at 200% of its book value. Book value is 50,000, 200% of which will give you 1 lakh. Building at 120%, if you find it out, it will be 3 lakh rupees, 2 lakh 15 to 120%. Now, nothing is mentioned about office equipment. Bacha, if nothing is given, that means realized value is not given, then what will you do? You will consider realized value to be their book value. Computers have realized 70%, 70,000, 70% comes to 49,000. Datas 95%, 4 lakhs 95% you will find out your figure, and stock 90% of 3 lakh will give you 2 lakh 70. Also, they have not given you any value for other current assets. Just like your office equipment, you will be considering this as this at which value? Book value. Now beta, when we sell the assets, what is the journal entry? cash is coming in, debit what comes in, cash bank account debit to realization account, because all these assets are transferred to realization account. So let us check our solution. Coming to my realization account over here. Yes. Buy cash account. Land, building, office equipment at book value. Computers 49, daters at 95% of 4 lakh, that gives you 380, and stock at 2 lakh 70, 90%. Again, other current assets, nothing is given, so it is discharged at its book value. Total cash received is 12 lakh 46, 600. Where will you show the second effect of this? In your cash bank account on the debit side. This is the amount received. We need to pay off our liabilities. How many outside liabilities are there? 2. Current liabilities and loan from NBFC. Let us see what have they mentioned about those items. Point B says, in case of loan, the lenders are to be paid at their instance a prepayment premium of 1%. When I am saying I have to pay a loan at premium, that means I have to pay at a higher value. What is the total amount of loan? 5 lakh rupees. And you have to pay at 1% premium, which gives you total amount payable of 5 lakh 5,000. Further, it is mentioned D is insolvent and no amount is recoverable from him. So basically, insolvency information is given. That means, have they given you any information about your current liabilities, at what value they are discharged? No. If nothing is given, just like your assets, I will discharge this at its book value 70,000. So let us see the effects of these two items. Now when I am paying, cash is going out, cash shall be credited, and what should I debit? Realization. So realization account on the debit side. To cash account, current liabilities 70,000 book value and loan at 5 lakh 5,000, that is 1% premium. Total balance to be paid is 5 lakh 75,000. Second effect, come to your cash bank account. On the credit side, by realization account, that is payment of all your sundry liabilities of 575. I hope this is clear till now. So what all things did you complete? You transferred all your assets and liabilities to their respective accounts, and you have sold all your sundry assets and paid your outside liabilities. Now who is supposed to be paid? Your owners. Who are the owners? Partners. Let us see what else have they mentioned. Mr. D is insolvent and no amount is recoverable from him. His father, Mr. C, agreed to bear 50% of his deficiency. But normally, insolvency loss is divided as per Garner versus Murray in Inter CA. But here it has been mentioned that out of the total insolvency loss, 50% will be borne by Mr. C. He is ready to bear his son's loss. What about the balance 50%? For that they have mentioned, the balance of deficiency is agreed to be apportioned according to law. Which law are they talking about? Garner versus Murray law. Correct? Okay. And last point, D says the assets were realized at the agreed, that is the adjusted values given above. We have done that. Assuming that the realization of assets and discharge of liabilities is carried out, show out your balances. So we have already completed 2 points. Discharged all the outside liabilities. Let us come to our owners. Now bacha, before paying our owners, this realization account includes your accumulated profits or accumulated losses of all the assets and liabilities that are discharged. And this profit or loss belongs to partners and should be divided between them in their PSR. So I'll find out the balancing figure, which comes to 24,000, and this will be divided between A, B, C and D. In which ratio? 4:4:1:1. 9,600, 9,600, 2,400 and 2,400. If I would have not prepared capital and current, then there was no option but to transfer this profit to capital account. But since I have two accounts, capital and current, but in that case you have learned that this should be transferred to current account because capitals are fixed. So we have transferred this to partners current account. This is your profit on realization. Second effect in current account, 9,600, 9,600, 2,400, 2,400. I have to pay my partners, I have to pay them capital as well as current balance. Instead of showing separately, let us prepare one account only now. So basically what are we going to do? We will transfer the balance of current account to their capital accounts. Now starting with Mr. D, he has debit balance of 87,400. His account was credited by 2,400, thus giving you balancing figure of 85,000. Second effect will be on the debit side of capital account 85,000. For the remaining partners, these are their balancing figures which I'll transfer to their individual capital accounts. Now whose accounts do we close first? We first close insolvent partners account because other partners are going to bear the loss. Now beta, if you see your capital account of Mr. D, 85,000 is debited and there is nothing on the credit side till here. That means 85,000 is completely receivable, recoverable, and nothing is received from his private assets. So what are we going to do? This entire amount will be treated as loss. According to the question, 50% of his loss is going to be paid by Mr. C, his father. What is the journal entry? Journal entry of this is solvent partners account debit to insolvent partner. Insolvent partner D has been credited. Who should be debited? Solvent, 42,500. Now, what about the remaining 50%? Remaining 50% needs to be divided between the remaining 3 partners. Now, what does Garner versus Murray say? Garner versus Murray says that insolvency loss should be distributed between partners in their capital ratios. In my sum, capitals are fixed. So, in which ratio? In fixed capital ratio. What are the fixed capitals? 2 lakh, 2 lakh and 1 lakh, which is in the ratio of 2:2:1. So, balance 50% loss is 42,500. If you divide it in the ratio of 2:2:1, you will get your balances as 17, 17 and 8,500. What is the journal entry beta? Solvent partners account debit to insolvent partner. Insolvent has been credited. I will debit all my solvent partners. These are the losses that they will bear over and above your basic profits and losses. Now, D's account is tallied. Let us come to A, B and C. I have to pay Mr. A 2,42,600, 3,42,600 and 1,61,600 to A, B and C respectively. These are their balancing figures. Amount to be paid towards their final settlement. This will be paid by cash. These are the balances and at the end your cash bank account will tally. Is this understood? A very simple sum given in RTP? Yes. The only new point is that Mr. C, his father, is going to bear 50% of loss. Okay. Done with our first question. Let us come to our next question. It is a theory question based on your LLP. Limited Liability Partnership. What is the question asking you to do? They have asked you to explain the nature of LLP and under what circumstances an LLP may be wound up either voluntarily or by the tribunal. Now, beta, when will you wind up the partnership firm or LLP? Few basic things that we all know. First, when partners are not mutually happy, when they decide that they want to wind it up. If tribunal thinks that they are not into some good work, they are doing some work which is not good for the society, then also you'll have to wind up. Maybe because when, let us say, there is only one partner left, so that is not a partnership firm. In that case, you will be winding up. If you have become insolvent, if the partnership firm is not able to pay debts, then you will wind up. Yes, these are the basic reasons. Let us see the answer. A limited liability partnership is a body corporate formed and incorporated under the LLP Act 2008 and it is a legal entity separate from that of its partners. This is the basic difference between LLP and normal partnership firm. A limited liability partnership shall have perpetual succession and any change in the partners of a LLP shall not affect the existence, rights or liabilities of the LLP. So, any change shall not affect LLP, any change in partners. Under the LLP Act 2008, an LLP may be wound up voluntarily or by the tribunal and such LLP so wound up may be dissolved. What are the circumstances under which it can be wound up? Here they have mentioned few. If LLP decides that it should be wound up by the tribunal, they are deciding it voluntarily. If for a period of more than 6 months, the number of partners in LLP is reduced below 2, below 2 is 1, if there is only one partner, then there is no partnership form. If LLP is unable to pay its debts, that is, it will be insolvent or will be declared as bankrupt soon. Second point says, if the LLP has acted against the interest of the integrity of India, the security of the state or public order, they are doing something wrong. Okay. If LLP has defaulted in filing of the statement of accounts and solvency with the registrar for a consecutive period of 5 financial years. If it is for 1 or 2, then there is no issue. But if it is for 5 consecutive years, then you will have to do what? You will have to wind up your LLP. And last point is, if the tribunal feels so, if the tribunal is of the opinion that it is just and equitable that LLP should be wound up, then you have to do it. Fair beta? Yes? Can we proceed? Okay. This was a theory sum. Let us come to our next practical sum. Question number 2. It is based on sale of partnership firm to a company. Now beta, this is your conversion chapter. Okay, converting partnership into a company. When partners are getting converted into a company, basically they are selling all its assets and liabilities to the company. So company has to pay something in return, and what is that something called as? Purchase consideration. Let us see the sum. You and we were in partnership, sharing profits and losses equally meaning 1:1. The firm's balance sheet as at 31st December 2021, this balance sheet is for 9 months, is as follows. You have certain assets, plant, building, debtors and stock. Now, 2 new points are P&L account debit balance, beta, this is loss. And you have partners drawings account. Normally, we show loss and drawings under capital account. Yes, we subtract these 2 figures from capital account, but in this sum, they have shown it separately. They have given you net capital balances. No, beta, they have given you gross capital balances. We can easily find out the net balance. How will you do that? Okay. Use capital is 1,50,000. Total loss is 60. And what is use share in it? 1:1. Okay, half of it, 30,000. So ideally, partners capital account use capital should have been 1,50,000 minus 30,000 loss and minus 8,000 rupees of their drawings. Similarly, for V, it will be 1,80,000 minus 30 minus 9,000. Sundry creditors are 90 and 80. 3,000 is your bank OD. Further, they are saying the operations of the business were carried on till 31st March 2022. If you see your last balance sheet date, the one that I have highlighted before, was 31st December 21, and the partners carried on their business for another 3 months. So before winding up or before selling entire business to company, we need our new balance sheet. And to create this new balance sheet as on 31st March 22, information is provided in the sum. Let us check that. You and we both withdrew in equal amount half of the amount of profits made during the period of 3 months. So here 2 information are given. First, in 3 months period, we have made net profits. And half of those net profits were withdrawn by the partners. Once I come to know my net profit, I will come to know my drawings. Okay, how did we earn this net profit? After charging debris of 5,000 on plant and after writing off 5% on building. So now I know what is my value of plant after 3 months, also for building. Now, 1,85,000 was original value, minus 5,000 will give you 1,80,000. Here, balance sheet of the firm as on 31st March 2021, 1,85,000 minus 5 is 180. For building, it is 1 lakh. Important part to be noticed is, it is after writing off 5% of building. Have they mentioned per annum? No. Which means this 5% is for 3 months period. So directly 1 lakh into 5% will give you 5,000. Your outer column figure will be 95,000. Further, they have mentioned during the current period of 3 months, creditors were reduced by 50 and even bank OD was reduced by 50,000. What is the present value of creditors? 90,000. It was reduced by 50, which will give you 40. And bank OD from 83 will now become 33. Over here, 40 and 33, 90 minus 50, 83 minus 50. Next, Stock was valued at 24 and debtors at 4,500 on 31st March 22. Stock 24 and debtors 4,500. Okay. The other items remain same as at 31st December 2021. There are no other items. Okay. Now beta, I have all my value of assets as well as outside liabilities. How did they get these two balances? Let us find it out. First of all, by finding the balancing figure in balance sheet, I will find out my total closing capital of the partners. So if you take your calcs, total of the assets are 3,39,500 minus 73,000 outside liabilities will give you total capital of total closing capital of 2,66,500 rupees. So this is the closing capital that we have found. Now next, we know one formula, that is opening capital plus profits minus drawings gives us closing capital. Now beta, do we know individual opening capital as on 1st April, in our case it is January, 1st January 2022? Yes, we know their individual capitals. For you, what will be their capital beta? 1,50,000. 1,50,000 minus his share of loss 30,000 and minus his drawings 8,000. 1,50,000 minus 30 minus 8. And for V, 1,80,000 minus 30,000 and minus 9,000. Correct? These are the individual amounts. Okay. Now, your closing capital will be as on 31st March 2022, that is after 3 months. Do you know your individual closing capital? No, that is what we are finding. Do you know your total profits for 3 months? No. Do you know your total drawings for 3 months? No. So let us assume total profits to be X. Accordingly, your total drawings will be 0.5x because it has been clearly mentioned that partners withdrew half of the amount of profits earned during the period of 3 months. That is 0.5x. Now, rather than considering individual, let us consider total. If you take your total of capitals, opening balances, 3,30,000, 1,50,000 plus 1,80,000 minus 60,000 minus 8 and minus 9 will give you your total opening capital of 2,53,000. Okay. My total drawings are X minus 0.5x will give me 2,66,500. In a way, I have formed the equation over here. Let us solve this equation further. 2,53,000 plus x minus 0.5x shall give you 2,66,500. Therefore, 0.5x will be equal to how much? 13,500. You will get your balance of x as 27,000. What did we term x as? X was your profits earned during the period of 3 months. And beta, your drawings are 0.5x. That gives you 13,500 rupees. How will you divide your profits? Profits will be divided in your profit sharing ratio and drawings will be divided in your given ratio. Your PSR is 1:1 and your drawings are also to be divided in the ratio of 1:1. It has been clearly mentioned. Now can we find out their individual balances? Yes. For you and for V. Okay, help me out. What are their opening capitals? I have given the bifurcation over here. 1,50,000 minus 30 minus 8. 1,12,000. And for V, it will be 180 minus 30 minus 9, 141. At profits of 27,000 in 1:1 ratio. that is 13,500 and 13,500. Minus drawings, 13,500. Is it in PSR? No beta, it is in the given ratio. That will give you 6,750, 6,750. You will get your individual closing balances. Yes, 1,12,000 plus 13,500 minus 6,750, 1,18,750, and 141 plus 13,500 minus 6,750 will give you your 1,47,750's balance. One lakh 18,750 and 1,47,750. These are the balances that we have found. Now, working for this is even given in your sum. How have they mentioned it? They have taken your total assets minus your outside liabilities. You got your balance of 2,66,500, which is your closing net assets, which is nothing but your closing capital. They have adjusted it against opening capital, 1,12,000 and 1,41,000. They got your net profits after drawings. So this represents what? Opening minus closing capital will represent profit minus drawings. Together it is 13,500. So beta, what will your profits be? 27 and drawings will be 13,500. So 27 minus 13,500 will give you net profits after drawings of 13,500. Is it clear to everyone? Yes? Okay. Now, this is your opening balance sheet. Coming to our next point. From here, conversion process will start. On 31st March 2022, the firm sold its business to UV Limited, the new company. Value of goodwill was estimated as 1,84,000. Okay, and the remaining assets will be based on the basis of their balance sheet as on 31st March 2022. Except building and stock, which were valued as follows: building 120 and stock 36,000. This will help us in calculation of PC. PC is calculated in two ways, either by net payment method or net asset method. We always first try to find out PC as per net payment method by asking ourselves two questions. If everything is mentioned, then the sum will be as per net payment. If even one of the two questions are not answered, then the sum will be as per net asset method. What are those two questions, beta? What is to be given and how much is supposed to be given? Let us see. UV paid the purchase consideration in equity shares of 10 each. You are required to prepare the following items. What is supposed to be given? Equity shares. How many equity shares? Not mentioned. So can you solve the sum as per net payment? Then the answer is no. Sum is as per net asset method. What is the formula of net assets? Value of assets taken over. Which value? Market value of assets taken over minus market value of liabilities taken over will give you net assets. That is the amount that the new company is going to pay to the partners. Let us see. All the assets and liabilities are taken over at their book values as on 31st March. That is according to the new balance sheet that we have prepared, except building and stock, which are taken over at 120 and 36. So let us calculate PC over here. My working note number 2. Stock will be taken at 36,000 and building at 120. Which other two assets were there? Sundry debtors at book value as on 31st March, which is 4,500, and plant at book value as on 31st March, which is 180. These were the four assets taken over. If nothing is mentioned about liabilities, it is taken over at their book values. Those are 40 and 33. But do not forget, along with all these, I have one more asset, and that is goodwill of 1,84,000 over and above the given assets. So your total PC to be paid is 4,87,500 rupees. And each share is of 10 rupees, which gives you how many shares? 48,750 shares are to be issued by the new company. Okay, next. They have asked you to prepare balance sheet of the firm as on 31st March 2022, which we have already done. Realization account and partners capital account showing the final settlement between them. Let us do that. Now, Next two accounts that we are going to prepare are your realization account and partners capital account. What does our basic rule says? That transfer all the balance sheet items to their respective accounts at book value, but which balance sheet, beta? The new which we have prepared over here. One by one, take each and every asset, transfer it to realization account. Plant, building, stock and debtors. Which outside liabilities do we have? Creditors and bank OD taken at the above values. Capitals of U and V we have just find out are in our working note number 1, 1,18,750 and 1,47,750. Here they have mentioned 1,18,750 and 1,47,750. So what have they done over here, beta? Before that, the working note which I prepared over here showing opening, profits, drawings and closing have been shown by ICAI by preparing their capital accounts. These are your opening capitals. Yes, your losses divided equally, your profits of 8 and 9, okay, and profits of 13,500 and 13,500, that was 27,000, and your extra drawings of 3 months was 6,750, 6,750, thus giving you these balances. We have already found out through our different working. You can do it in whichever way you want. Yes, we have carried down these balances over here. Now, opening balances are considered. Step number 2. All the assets and liabilities will be sold to the company, and company will in return will give us purchase consideration. So we need to record the purchase consideration and receive it. For recording, partners are demanding PC. So partners will make the new company their debtors. Which is the new company? UV Limited. UV Limited accounts debit, and what are they giving? All their assets and liabilities which are there in realization account. So over here, realization account shall be credited and UV Limited will be debited by 4,87,500. That is the total amount demanded. Second effect will go to UV's account, which we have not prepared. Okay. You will receive the PC. In what form? In the form of equity shares. What is the journal entry? You will say, sir, we are getting equity shares. Equity shares in UV Limited account debit to UV Limited account. Again, we have not prepared both the accounts, so we are not going to give any effect. Now I have received the shares. I'll keep it with me. I'll close my partner's capital account. How, beta? I need to check my realization profit or losses. We'll find out the balancing figure and divide it in the ratio of 1:1. PSR. 1,10,500, 1,10,500. Okay. Here. 1,10,500, 1,10,500. Now, beta, this amount is to be paid. How are we going to pay this amount? In the form of equity shares. But bacha, the point is, they have not given you how are these equity shares to be distributed between the partners. If nothing is given, we distribute it between the partners in their final settlement ratio. That is in the total final amount. What are the amounts to be paid? These are their balancing figures. And if you check the total, it will be equal to 4,87,500. That is the total amount of shares received. And I will give them these amounts. That is how the sum is completed. Partners' liabilities are discharged by issuing them equity shares of new company. Is this clear? Quite a simple sum. What is new part of the sum? That you have to prepare a new balance sheet, and based on that balance sheet, the further sum is going to be solved. This entire sum is regular sum. You can do it easily. Okay. Can we now proceed? Yes? Okay. Let us come to our next concept, next sum. Accounting for ESOP. This is your employee stock option plan chapter. First, you have theory question. They are saying define the following terms. Let us discuss this. Vesting. You all know vesting period. What do you mean by vesting period, or what do you mean by vesting over here? Vesting means to become entitlement. What do you do in vesting period? You fulfill a condition, and after fulfilling that condition, you will be entitled to receive ESOP. Whether to take it or not, that is another story. That depends upon employees. But whether they will be entitled to get that share or not will depend upon the vesting period. They have mentioned under an ESOP plan, a counterparty's right to receive cash or other assets or equity instrument of the enterprise vests when the counterparty's entitlement is no longer conditional. What do you mean by being no longer conditional? Meaning that is fulfilled on satisfaction of the vesting conditions. You need to satisfy the condition and fulfill your duties in order to get the shares. Second item is grant date. What do you mean by grant date? The date on which the company offers or announces that the company wants to give ESOP to its employees. Yes. Grant date is the date at which the enterprise and the another party, who is the other party beta? Employee, agree to an ESOP, being when the enterprise and the counterparty have shared understanding of the terms and conditions of the arrangement. They both are agreeing to some terms and conditions. At the grant date, the enterprise confers on the counterparty the right to cash and other assets or equity instruments of the enterprise, provided the specific vesting conditions, if any, are met. So on the grant date itself, they will tell you what is the condition to be fulfilled. If you fulfill it, you will get the ESOP. If that agreement is subject to an approval process, for example by shareholders, grant date is the date when that approval is obtained. Okay, beta. Next, exercise price. What do you mean by exercise price? The price at which the employees, or you can say counterparty, will pay the amount and will obtain the ESOP. Will it be equal to market price? No, it will be less than the market price. Let us say if market price is 100, company is asking, please pay us only 60 rupees. Then what is that 60? That 60 is your exercise price. Point number 3. Exercise price is the price payable by the counterparty or the employee for exercising, that is for subscribing the option granted to him, her or it in pursuance of ESOP. Okay, these are your simple points. Now, after theory comes your important practical sum. Point number B. Let us read the sum, understand. Simple sum has been asked. Noor Limited has its share capital divided into equity shares of 10 each. This is your face value. On 1st January 2021, it granted 4,000 employee stock options. Options meaning shares. 4,000 shares were granted at rupees 40 per share. Meaning, please pay me 40. I am ready to give you 4,000 equity shares, that is ESOP. So what is your 40 rupees beta? 40 rupees is your exercise price. And at that time, your market value was 60 rupees per share. So if at all I have to do a working for your next question, I will be saying market value is 60 rupees. We are demanding cash of 40 rupees only, which means company is ready to bear expense. Company's expenses will come to rupees 20 per share. What have they mentioned? Fair value per option was 20. What do you mean by fair value per option? Fair value per option is nothing but company's expense. Now beta, fair value per option is company's expense. And if the question says fair value of shares on that date, means market value. I repeat, fair value per option is company's expense and fair value per share is the market value. In our sum it is given fair value per option. So our expenses are 20, which we otherwise also could have found out easily. Next, the options were to be exercised between, important dates are 15th March 21 and 31st March 21. Now beta, please see the dates that I am highlighting. Grant date is 1st January 21 and exercise period is 15th March to 31st March 21. Tell me students, are these two dates in the same financial year? Then the answer is yes. It is within the period of 3 months from January till March. If the exercise period and the grant date are in same financial year, then we will just pass 2 entries at the end of the year, or I will say during the exercise period. Yes? Okay. The employees exercise their options for 2,500 shares only and the remaining options lapsed. Now when I am going to pass entries in the exercise period, I will pass entry for 4,000 shares or 2,500. Then the answer is only 2,500. That means, am I supposed to pass any entry for lapse? Then the answer is no. But if you pass entry for 4,000 shares, then record only 2,500, that means you have to pass one entry for lapse period also. But in my case, I am just going to pass entries for 2,500 shares. Company closes its books every year on 31st March. You are required to give journal entry with narrations as would appear in the books of company for the year ending 31st March 2021. Okay, what will be the journal entry? Now, you are going to receive cash. So, cash bank account debit on 2,500 shares. What is the total value of cash to be received? 40 rupees. So, 20 rupees is going to be our expenses. What does our golden rule say? Debit all expenses and losses. Employee compensation expense account debit. Per share expenses are 20 rupees. So, on 2,500 shares, you will be incurring total 20 rupees. What have you done by incurring these expenses? You have issued shares to equity share capital 2,500 into per share 10 rupees. And to securities premium. Beta, what was the market value? 60. Out of 60, if my face value is 10, my securities premium shall be 50. So these two are 60, these two are 60, your entry will tally 2,500 into 50. You can find out your figures. Yes. Now this is your first entry. Next, bank is asset. Equity share capital and securities premium will be reflected on your liability side, but employee compensation expenses are your expenses which are supposed to be transferred to P&L at the year end. So I'll transfer this to P&L account debit to employee compensation expense account. Okay, on which dates will you pass this entry? Cash is received during the period of those 15 days exercise period. So here you will be showing your entire exercise period from 15th March till 31st March 21, and you transfer your expenses at the end of the year, that is 31st March 21. Is this clear to everyone? Yes. Let us see the journal entries. First entry, from 15th March 21 to 31st March 21, bank account debit 2,500 shares into 40, just like we discussed, 1 lakh. Employee compensation expenses 2,500 into 20, to equity share capital 2,500 into 10, and to securities premium 2,500 into 50. Now your expenses are of rupees 50,000. You will transfer these expenses to your P&L to employee compensation expenses 50,000 rupees. What notes have been given? They have mentioned that no entry is passed when the stock options are granted. When did we grant? On 1st of January. Therefore, no entry will be passed on 1st January. We will pass entries on which date? On the last date, that is year-end exercise period. Fair value per option is 20 per option. Is the employer's cost, employee's cost, or employee compensation expenses. It is employer's cost or employee compensation expense, and will be charged to P&L for the number of options exercised. We have done that. Is this sum simple? Yes. Okay. Next. Your next chapter is based on buyback of securities, buyback of equity shares. Again, a very simple chapter. Now this chapter includes two things in your syllabus. First is your basic journal entries for buyback, which are very much similar to redemption of preference shares of your group 1. And second are your 3 legal conditions. Quickly, what are the 3 legal conditions? Okay, to calculate the maximum number of shares that you can buy back, you need to first identify your maximum number of shares as per legal condition number 1, which says in a financial year, you cannot buy back more than 25% of your total equity shares, paid up shares. Second condition says that maximum expenditure on buyback should not exceed 25% of your equity base. And the third condition says your debt equity ratio should be 2 after buyback, post buyback. In this sum, have they asked you to follow the legal conditions? Let us read. Complicate Limited, an unlisted company, gives you the following information as on 31st March 2021. Equity shares of 10 each fully paid up are given as 13,50,000. Share option outstanding account. Now this is your ESOP wala account. Yes, which is this account? Employee stock option outstanding. And where do we show this? Under reserves and surplus. Is this a free reserve? No. It is not to be considered as a free reserve. So will we use it for buyback? No. Next, revenue reserves are your free reserves, meaning your divisible profit. Securities premium will be considered for buyback. Yes, both these things will be considered. P&L account is also your divisible profit. Are capital reserves your divisible profit? No. Unpaid dividends are your liabilities. 12% debentures are your long-term liabilities, will be considered for debt if at all they ask you to find out your maximum number of shares. Next, advances from related parties are again long-term in nature. Current maturity of long-term borrowings are given. Application money received for allotment which is due for refund. Property, plant and equipment are your fixed assets, and then they have given you your current assets. What does the company ask you to do? Company wants to buy back 25% of equity shares of 10 each on 1st April 21 at rupees 15 per share. What is your face value? If at all you check, your face value is 10 rupees and you want to buy back it at 15, which means 5 rupees is your premium on buyback. Buyback of shares is duly authorized by its articles and necessary resolution have been passed by the company for this. The buyback of shares by the company is also within the provision of Companies Act 2013. What provisions are they talking about? Those 3 legal conditions. So, but they are saying already the 3 legal conditions have been taken care of. Are you supposed to identify that? No. Next, the payment for buyback is made out of companies, made out by the company out of sufficient bank balance shown under current assets. Okay. If you all can see, I have current assets of 40 lakhs. From here, I have shown my buyback. You are required to prepare the necessary journal entries towards buyback and prepare balance sheet after the shares are bought back. So, no need to show your 3 steps, maximum number of shares to be buyback or not to be done. Question has asked you to buy back 25,000 shares, so do it. Now, which all entries will be passed? Let us think. Have we issued any new shares? No. Are we going to sell any assets in order to arrange cash? No. We are directly going to buy back the shares. After doing that, you need to write off your premium on buyback. What can you use to write off your premium on buyback? Which reserves? Can I use securities premium? Yes. If that is not sufficient, then I can use my revenue reserve or P&L account. I need to create CRR and make the payment. So basically 4 entries will be there. First, making the amount due, payment, premium on buyback to be written off, and creation of CRR. Premium on buyback can be written off using securities premium, and CRR has to be created out of divisible profits. Let us check the entry. 25,000 shares of 10 each are to be bought back at 15. So, equity shares have credit balance. I want to remove them. I want to buy back them. I will debit it. Journal entry will be equity shares buyback account debit to bank account. What is the total amount to be paid? 25,000 shares into 15 rupees. Please check. You have made the payment. Payment against what? Payment against equity share capital of face value 10 and premium on buyback on 25,000 shares 5 rupees. 2,50,000 and 1,25,000, total 375. Now this premium needs to be written off. If I check my question, what is the total value of securities premium available? 2,50,000 and my premium is only 125. So I can use that securities premium to premium on buyback. And better tell me, what is the total value of capital reduced in the company? Total face value of the capital reduced is 2,50,000. So CRR should be created to the extent of face value of the capital reduced in the company, which is 250. I will use my revenue reserve because only divisible profits can be used. So revenue reserve is of 15 lakh. We have sufficient balance. I'll use that. Okay. Now, after passing these entries, I need to prepare my new balance sheet. Let us think. According to my question, original equity shares were 13,50,000. Out of 13,50,000, what is the face value of shares bought back? Here, I'll tick mark entries which I am considering. I'll say out of total 13,50,000 credit, 2,50,000 is gone. So balance 11 lakh is pending in my account. Okay. Coming to your next point, reserves and surplus. Please take your calcies. Revenue reserve was 15 lakh rupees. Out of 15 lakhs, you have utilized revenue reserve of 2,50,000. So your balance and revenue reserve shall be 12,50,000. Here they have given you revenue reserve 12,50,000. Next, securities premium was 2,50,000. Securities premium was 2,50,000. Out of 250, you utilized 1,25,000 rupees. Yes, so 1,25,000 will be reduced. Balance will be 1,25,000. Next, you have P&L account of 1,25,000 again. So P&L will be as it is 125. Beta, share option outstanding account of 4 lakhs will be shown under the heading reserves and surplus. You must have discussed this in your ESOP chapter. 4 lakh are your reserves and surplus. And do not forget, one important reserve is CRR of 2,50,000 which you just now created in your last entry. Apart from this, do you have any other reserve? Yes, we have capital reserve of 2 lakhs. That shall also be shown under the heading reserves and surplus. So these are your total reserves. You will take the total, you will get it as 23,50,000. I'll show this under my heading reserves and surplus. Coming to my next point, long-term borrowings. Unpaid dividends are not long-term in nature. 12% debentures are long-term, 18,75,000, and advanced from related parties is specifically mentioned to be long-term, 10 lakh rupees. So this will give you total 28,75,000, for which again a note is created. These two items are simply mentioned and total is taken in the outer column. Next, I have current maturities of long-term borrowings and I have unpaid dividends. What have they considered these to be? Short-term borrowings are your current maturities of long-term borrowings. But unpaid dividend are not your borrowings, they are your other current liabilities. So 1 lakh is considered there. Okay, what next do we have? Application money was received for allotment, but I have to refund it. If I have to refund it, it is payable and I will shortly refund it, meaning it is again your other current liabilities of 2 lakh rupees. Total 3 lakhs. These are your liabilities. I have considered these things. Next are our non-current assets. Property, plant and equipment will remain the same, but important is current assets. Since we have made the payment, our cash will be reduced. Your original balance was 40 lakhs given in the question and you have paid total 3,75,000 towards face value as well as premium. So your net balance will be 36,25,000 and your balance sheet will tally accordingly. Quite a simple sum. Yes, everything is mentioned. This is it. You don't have to worry much about it. Okay. So this was your ESOP buyback of securities. Now coming to my next concept, that is equity shares with differential rights. Okay. What do you mean by equity shares with differential rights? You can issue two types of shares. One which has voting powers, another which do not have voting powers. So they have asked you two questions. One is theory, one is practical. Let us see the theory first. Explain the conditions for equity shares with differential rights under Companies Act, shares and capital and debentures rules. Share capital and debenture rules. Okay. So under what conditions can you issue those equity shares? First of all, if some different type of shares are to be issued, they have to be approved by your articles. Permission from shareholders needs to be taken. Okay. Other basic points which are there are, first, you have to make sure that your company has made no defaults in past. Your company is not penalized before. Okay, all the rules and regulations were properly followed by the company and all these things are given in detail over here. Let us read it. Companies share capital and debenture rules deals with the equity shares which have differential rights. The rules lay down the condition to be compulsorily complied with. The articles of association of the company should authorize the issue of such differential rights. Second point says the issue is authorized by an ordinary resolution passed at the general meeting of shareholders. Obviously, you have to ask the shareholders also. Provided that where the equity shares of a company are listed on recognized stock exchange, the issue of such shares shall be approved by shareholders through postal ballot. Okay. The voting power in respect of shares with differential rights shall not exceed, important point, 74% of the total voting power, including voting power in respect of equity shares with differential rights at any given point. What are they saying, beta? The total voting power of differential rights should not exceed 74% of your total voting power. So if you issue differential shares, okay, their voting power should be maximum 74% only. Remaining should be for others. Company has not defaulted in filing the financial statements and annual returns for at least 3 financial years preceding the financial year in which it has decided to issue such shares. Company has no subsisting default in payment of declared dividend to its shareholder or repayment of its matured deposit or redemption of its preferences or debentures. Basically, company should not have done any defaults, okay, that have become due for redemption. Next. Company has not defaulted in payment of dividend on preferences or in repayment of any term loans or public financial institution or state level financial institution or from any banks. So basically, there should not be any default in payment of dividend or in payment of the principal amount. That principal can be taken from banks, can be taken from your state level financial institution, from your scheduled banks, from your other public financial institution, anyone. Okay. That has become repayable or interest is payable thereon or dues in respect of such statutory payments relating to its employees to any authority or default in crediting the amount in investor education and protection fund to the central government. In short, there should be no default. Company's account should be clean, provided that the company may issue equity shares with differential rights upon expiry of 5 years from the end of the financial year in which such default was made good. Let us say company made a default. Then what can the company do? Will the company never issue those shares? Company can issue those shares provided after making the default 5 years have passed. Okay, next. Company has not been penalized by court or tribunal during at least last 3 years of any offence under the RBI Act, the SEBI Act, the Securities Control Regulation Act, SCRA, FEMA, or any other special act under which such companies are being regulated. Basically, there should be no bad points in the company. Only then you can issue shares with differential voting rights. Now, this was your theory. Important practical question. L, M, N and O hold equity share capital in the proportion of 30:30:20:20, which basically says 3/10, 3/10, 2/10 and 2/10. In Hill Limited, okay, X, Y, Z and K hold preference share capital in the proportion of 40:30:20:10, which is 4:3:2:1. Which in other words is 4/10, 3/10, 2/10, 1/10. You are required to identify their voting rights of the shareholders in case of resolution of winding up of the company if the paid up share capital, but this paid up is equity share capital, okay, they have given it in solution. Paid up equity share capital of the company is 60 lakhs and preferences in the company is 30 lakhs. Now, how to solve this sum? A simple sum. Okay, what are they discussing? First of all, but if I am saying my total capital in the company is 90 lakhs and total capital comprises of equity share capital plus preference share capital, equity 60, preference is 30, total is 90. All of them have voting powers. So beta, out of total 90, 60 is equity, preference is 30. In other words, can I say all the equity shareholders have 2/3 right in the company and all the preference shareholders have 1/3 right of voting in the company? So all the equity shares capitals or all the equity shareholders' rights shall be calculated basis on the 2/3 of the voting power that they have, and preference shareholders' voting rights will be calculated on the basis of 1/3 of the voting power that they have. Now, I have how many shareholders given in the sum? We have total 8 shareholders provided in the sum. L, M, N, O, X, Y, Z and K. Now, first 4 are holding equity shares in the ratio of 3:3:2:2. So, I will be saying for them L, M, N and O. I will say your voting right in the company is out of equity shares, which is overall 2/3 share of the company, and out of this 2/3, which indicates 60 lakhs, out of the 60 lakhs, how many shares do you have? You have shares in the ratio of 3:3:2:2, which means out of 2/3, your proportion is 3/10. Similarly, for M, 2/3 into 3/10. For N, it will be 2/3 of equity, 2/3 represents equity shares into 3:3:2:2. So 2/10 and 2/3 into 2/10. So what are their voting rights? If we calculate, you will get the amount 3 cancelled, 2/10, that is 1/5. Again over here 1/5. This will be 4/30, which is 2/15. 2/15. Yes, let us see the solution. 3/15. For L, 2/3 into 30 into 100, which is 3/10, is 3/15, which is also 1/15. 2/3 into 30 is 3/15, which is 1/5, not 1/15, I'm sorry, 1/5. 1/5, 1/5. Next, 2/15 and 2/15, 2/3 into 20 into divide by 100 and 2/3 into 20/100. These were for your equity shareholders. Now, the remaining 4 are your preference shareholders. I will say, sir, overall, your voting right in the company is 1/3. And out of that 1/3, how much is Mr. X holding? X is holding 40% basically. Y is holding 30, Z 20 and K 10. So 1/3 40 will come to 2/15. 1/3 30 will be 1/10. 1/3 20 will be 1/15, and so will you get 1/30. Yes. What is the theory given above? The one that I have explained you orally. Let us read. L, M, N and O hold equity capital, and it is held in the proportion of 30:30:20:20. And X, Y, Z and K hold preference share capital in the proportion of 40:30:20:10. As the paid up equity share capital of the company is 60 lakhs and preference shares is to 30 lakhs, that is in the ratio of 2:1, the relative weights of voting of equity shareholders and preference shareholders shall be 2/3 and 1/3. So total is 2/3 and 1/3. Out of 2/3, L's share is 30%. Accordingly, we have calculated L's share and so on for all the remaining shareholders. Is this clear, beta everyone? Yes. So these were your basic 5 questions that we have done till now. Okay. Yes. So now let us start with our next sum of our next chapter, that is Amalgamation of Companies. Now a good sum has been asked in RTP. Let us see that. It says the following are the balance sheets of Akash Limited and Ganga Limited as on 31st March 2021. 2 companies are given, Akash and Ganga. Okay. The balance sheet reads, equities and liabilities, you have shareholders fund under which share capital and reserves are given. Reserves of Akash are negative. Non-current liabilities, we have 2 liabilities, secured loans and unsecured loans. Under current liabilities, we have trade payables and other current liabilities. Okay. Assets, first we have property, plant and equipment under the heading non-current assets, long term. And then under the heading current assets, we have inventories and other current assets. Now they have given you 5 notes, which includes share capital, reserves in surplus, secured loans, unsecured loans and other current liabilities. Let us first see our share capital. Authorized, issued and subscribed. Akash Limited had equity as well as preference shares, whereas Ganga only had equity shares. In reserves and surplus, you have 2 types of reserves, general reserve and surplus. What do you mean by surplus? This is P&L account having debit balance because it is loss. For Akash, you have both the items. For Ganga, you just have general reserve. Secured loans are for Akash as well as Ganga, but something important has been mentioned. It says, secured loans of Akash are secured against pledge of inventories and the loan amount is 3 crore 20 lakh rupees. Let us see what is the value of inventories. Value of inventories for Akash is 3 crore 68 lakhs. We'll see what to do with this later. Unsecured loans only of Akash are 1 crore 72 lakhs. Other current liabilities include statutory liability and liability to employees. It has been said both the companies go into liquidation and a new company, Akash Ganga Limited, is formed to take over their business. So now how many companies are to be dealt with, beta? 3. Akash Limited, Ganga Limited and Akash Ganga Limited. We have learned how to close the books of old company and how to open the books of new company. But right now, from whose point of view are we supposed to think? For that, let us read the last line. What are we supposed to do? You are supposed to prepare opening balance sheet of new company as on 1st April 2021. Which means, are you going to think individually from Akash Limited's point of view or Ganga Limited's point of view? No. You will think from new company's point of view. So now, new company Akash Ganga Limited is supposed to give purchase consideration individually to Akash Limited and to Ganga Limited. PC is calculated in 2 ways, net asset method and net payment method. Beta, if the sum is as per net asset method, then your formula will be value of assets taken over. Which value? Market value of assets taken over minus market value of liabilities taken over. You will get your answer, that is your PC. If the PC is as per net payment method, then you will get your lump sum payment, after which you will again find out what are the market value of assets taken over and market value of liabilities taken over, so that you will get your net goodwill or capital reserve. So in either cases, we have to know what are the values of assets and liabilities taken over. For that, I am just keeping my format ready for Akash Limited and Ganga Limited. First, I need market value of assets taken over. Here, point number 1 says, all the current assets of the 2 companies except pledge of inventory are to be taken over by the Akash Ganga Limited. The realizable value of current assets including pledge of inventory is 80% of book value in case of Akash and 70% in case of Ganga Limited. Beta, they have given you book values of all the assets including inventories. But which assets are taken over? All the current assets except inventory. So I'll come to my original balance sheet. Under the heading current assets, I have 2 assets, inventories and other current asset. This is not taken over and these are taken over. At what value? In case of Akash, 72 lakhs into 80%. So here, other current assets are taken over at 57 lakh 60,000, and for Ganga it is 1 crore 92 lakhs into 70%, that will give you 1 crore 34 lakh 40,000 rupees. Inventory is not taken over. One thing at a time. Now come to adjustment 2. Property, plant and equipment of both the companies are taken over at book value by Akash Ganga Limited. So no change in their values. I'll again come to my asset. Totally, I just have 3 assets. Property, plant and equipment, inventories and other current assets we have already seen 2. The last one is taken over at book value, 68 and 136. 68 lakhs, 1 crore 36 lakhs. These are the value of assets taken over. Let us see the next point. Point number 3. Secured loans include 32 lakhs of accrued interest in case of Ganga Limited. What to do with this? We'll wait. Maybe some other adjustment is given, correct? Next, most important adjustment of the sum. 4 lakh equity shares of 10 each are allotted by the new company Akash Ganga Limited at par against cash payment of entire face value. And whom is this issued to? This is issued to shareholders of Akash Limited and Ganga Limited in the ratio of shares held by them individually. First thing, whose books are we here to prepare? Akash Ganga. How many shares Akash Ganga has issued? 4 lakh equity shares of 10 each. Now, shareholders of Akash will get it, shareholders of Ganga will get it. In what ratio? Let us not worry about this. Why? Because we are not going to prepare books of Akash Limited individually and Ganga Limited individually. We will say new company has issued equity shares. So, madam, this is PC, correct? Then the answer is no. This is not your purchase consideration. Reason being the highlighted part. The shares are issued against cash payment. Meaning, if at all you are shareholders of Akash Limited and Ganga Limited and I am new company, I have issued you shares and you have given me cash for that. Purchase consideration is for all the assets and liabilities taken over. Have I given you that 4 lakh equity shares for that purpose? Then the answer is no. This is not part of PC. Also beta, when equity shares of Akash and Ganga are going to give me cash, it means that I am not going to issue them any other purchase consideration. One more time. But here it has been said that individually both the shareholders are going to give the new company amount in the way of cash. They will be issuing equity shares and giving you cash payment. Normally in amalgamation, new company straight away gives equity shares. Does it take cash in return? No. That means in this sum, purchase consideration will not be paid to equity shareholders. Why so? If at all you check, your surplus was in negative balance. Correct, beta? So already the company is going into losses. And that is why more amount is demanded rather than giving them purchase consideration. And that is why I said this is one of the most important adjustments. This was for equity shareholders. We have 2 types of owners, equity and preference. Let us see what will preference shareholders get. Preference shareholders in Akash are issued equity shares in Akash Ganga in the ratio or worth 4 lakh rupees in lieu of their present holdings. Not in the ratio, directly 4 lakh rupees. Also, only Akash Limited had preference shareholders. Ganga Limited did not have any preference shares. So straight away it has been said that preference shareholders will get only 4 lakh worth rupees of equity shares. Is it clear? Next. Secured loans agreed to continue the balance of their amounts to Akash Ganga Limited after adjusting realizable value of pledge asset in case of Akash Limited. One thing at a time. What are they saying? Secured loans will again form part of Akash Ganga Limited. In other words, can I say Akash Ganga Limited is taking over secured loans? Yes. But at the original value, no. They have been said that it has been taken over after adjusting realizable value of pledge assets in case of Akash Limited. So here, what is the value of my secured liability? 3 crore 20 lakhs, okay, minus market value of liabilities taken over. What is the value of liability taken over? One by one. Secured liability. For Akash Limited, value is 3 crore 20 lakhs minus value of inventory is 3 crore 68 lakhs. But if you remember, inventory is also valued at 80%. If you value inventory at 80%, you will get 2 crore 94 lakh 40,000 rupees. Subtract these two figures, you will get your amount of 25 lakh 60,000. So, beta new company Akash Ganga will take over secured loans of Akash 25 lakh 60,000. Next. Second point is, point number 6, second part, last line. And after waiving 50% of the interest due in case of Ganga Limited. So, we have 60%, we have Ganga Limited secured loans also. Total value is 1 crore 60 lakhs. And this 1 crore 60 lakhs include, read point number 3, 32 lakhs worth of accrued interest. Is the entire loan taken? No, bacha. Loan only to the extent of principal amount and balance 50% of interest is taken. So, I will say, out of 1 crore 60 lakhs, will you consider entire 32 lakhs? No. So, for Ganga Limited, entire loan including interest is 1 crore 16 and 50% of interest comes to 1,60,000 is waived. So, what is the balancing figure, bacha? 1 crore 44 lakhs. This is the value of secured loans considered by Akash Ganga for Ganga Limited. Next. Unsecured loans taken over by Akash Ganga are at 75% of loan amounts, okay. Let us see unsecured loans. Only Akash had unsecured loans. 1 crore 72 lakhs into 25%. This is the only value which you will be taking over, which comes to 43 lakhs. Here, unsecured liabilities or unsecured loans, 43 lakhs. Next. Employees are issued fully paid up equity shares in Akash Ganga in full settlement of their dues. So, first I will be taking over their liability. What liability I am taking over, beta? Full value. Your employee dues were 60 lakhs and 36 lakhs. Employees liability 60 lakhs and 36 lakhs. What will we issue them? We will issue them equity shares. Okay, we'll do that. And last, statutory liabilities are taken over by Akash Ganga at full value and trade payables are taken over at 80% of book value. One thing at a time. Statutory liabilities are taken over at full value, 1 crore 44 lakhs. And 20 lakhs. Trade payables are taken over at 80% of book value. What is the value of trade payables? Have they given you over here? No. Check your balance sheet. No note is prepared for trade payables directly. 56 lakhs into 80% will give you 44 lakh 80,000 in case of Akash and 36 lakhs into 80% will give you 28 lakh 80,000 in case of Ganga. So basically these are the assets and liabilities taken over. Yes, let us see balance sheet. All the assets have been considered. In liabilities, have we considered secured loans? Yes. Have we considered unsecured loans? Yes. Have we considered trade payables? Yes. And other current liabilities? Yes. All the outside assets and liabilities are considered. We know which are taken over, we know which are not taken over. Correct, beta? So find out what is the value of net assets taken over. In case of Akash, 57,60,000 plus 68 lakhs gives you 1 crore 25,60,000 worth of assets. 1 crore 34,40,000 plus 1 crore 36 lakhs will give you 2 crore 70,40,000 worth of assets taken over. Yes. Now beta, what has module done? What is shown in RTP? The same thing is shown in RTP under separate workings. Working note number 2 says value of assets taken over by Akash Ganga Limited 1 crore 25,60,000 and 2 crore 70,40,000. This is what we have found out, right? Now coming to liabilities one by one. 25,60,000 plus 43 lakhs plus 60 lakhs and plus 1 crore 44 lakhs plus 44 lakh 80,000. Total liabilities taken over are 3 crore 17 lakh 40,000 rupees. Yes, and over here 144 plus 36 plus 20 plus 28 80. 2 crore 28 lakh 80,000. Let us confirm if these are the same figures given in our sum. Current liabilities, they have taken statutory liability to employees and trade payables for both the companies. We have also considered that. Secured loans. In balance sheet 3 crore 20 lakhs minus realizable value of inventories. This will give you net 25 lakh 60,000. We have also considered 25 lakh 60,000. 1 crore 60 lakh minus 16 lakhs is 144 in case of Ganga. Same is considered by us, 144 in case of Ganga. Next, 43 lakhs in case of unsecured loans and 43 lakhs in case of unsecured loans. We have also done. These three were taken first. So basically, these are the total values 317, 40 and 228. Correct, beta? Here is your answer. 317, 40 and 228, 800. But can you find out net assets taken over? All you have to do is assets minus liabilities taken over. In case of Akash, you will get negative balance. What is the negative amount? 3 crore 17 lakh 40,000 minus 1 crore 25 lakh 60,000 will give you negative 1 crore 91 lakh 80,000. What does this represent? That we are taking liabilities more than assets. That means, should we pay any purchase consideration to them? Ideally, no. In case of Ganga, it is 2 crore 28 lakh 80,000 and over here 2 crore 70 lakh 40,000. Here you are getting positive amount of 41 lakh 60,000. These are your net assets taken over. Now let us see what is our purchase consideration as per net payment method. Net payment method tells you to ask two questions. What is supposed to be given and how much is supposed to be given? In case of Akash, what is supposed to be given? To equity shares, nothing. We have to collect money from them. And to preference shares, I have to give preference share rupees 4 lakhs. Where was it given? In point number 5. What about Ganga Limited? What is to be given? Nothing, because we are going to receive money, which is said in point number 4. So beta, here for Akash Limited and Ganga Limited, purchase consideration is for preference shareholders 4 lakh rupees, Ganga Limited nothing, and for equity shareholders nothing. So total PC will be 4 lakhs only and 0 nil. This is the most important part to be understood in the present sum. Okay. Now let us find out what is the value of capital reserve or goodwill. Calculation of capital reserve slash goodwill for both the companies. What is their PC? 4 lakhs and nothing against net assets taken over. Here you will get negative figure of 1 crore 91 lakh 80,000 and 41 lakh 60,000. So let us understand this logically. But first of all, for Akash, you are not supposed to give them anything. The figures were already in negative balances and still you gave them 4 lakh rupees. Correct? So can I say it is just adding up to your loss? Your total amount will be 1 crore 95 lakh 80,000 rupees. Okay, 1 crore 95 lakh 80,000 rupees. What will we consider this as? This is our loss, and loss is supposed to be treated as goodwill. What is the purchase consideration given to Ganga? Nothing. And what are the assets taken over? 41 lakh 60,000. So can I say in a way it is profit of 41 lakh 60,000 for the new company? And how does the new company treat their profits as? Capital reserve. Now I will not show both the items in my balance sheet. So I want to calculate what is my net goodwill or net capital reserve. In my case it will be net goodwill as it is more. 1 crore 95 lakh 80,000 minus 41 lakh 60,000 will give you 1 crore 54 lakh 20,000 worth of goodwill. I hope you all have understood this. Yes? Is this the same answer given in the sum? Yes, beta. They have first calculated working note 1 value of liabilities taken over, then working note 2 value of assets taken over, and then their goodwill or capital reserve net amount is same. The presentation is quite different. That is okay. Yes. Next. Now, I want to prepare balance sheet of new company. Balance sheet will include all the assets and liabilities. Assets and outside liabilities will be the one that are taken over. But what about equity shares? We will have to calculate that. In our sum, how many times did the new company issue equity shares? Let us see. In first adjustment, no equity shares are issued. In second adjustment, no equity shares are issued. Neither in third one, but in fourth one, 4 lakh equity shares of 10 each are issued at par. No securities premium. So total value of equity share capital issued for cash is 40 lakh rupees. Have we issued equity shares further? Yes. In the next point, preference shares. Yes, preference shareholders were given equity shares worth rupees 4 lakhs, not 4 lakh shares, rupees 4 lakhs. So here, preference shareholders are given 4 lakh rupees. Next. Secured loans will continue to stay. Yeah, no equity shares are issued. Unsecured loans will be taken over at 25%. No worries. Employees will be issued equity shares in full settlement of the dues. Again, equity shares are issued. Correct. What were the total dues? If at all you check things over here, liability of employees are 60 lakh and 36 lakhs, which will give you 96 lakh rupees worth of shares. 96. Correct? Total 1 crore. What else is there? At the end, they have told about the statutory liabilities taken over and trade payables. That is again okay. No equity shares. So total 40 lakhs for cash and 1 crore. 1 crore 40 lakhs. Each share is of 10 each, which gives you 14 lakh shares of rupees 10 each. This will be my total share capital of new company. Let us check our main answer. Is our total share capital 1 crore 40 lakhs? Yes. I hope this is understood. Next. We have considered all our working notes. Now what are we supposed to do? Complete the balance sheet. In balance sheet, you will be showing goodwill as per working note 3 of 1,54,20,000. Where will you show goodwill? Under the heading intangible assets. Here it is. Okay. Now, do we take over reserves and surplus? No. We take over only assets and outside liabilities. Which all assets and liabilities are taken over? Here is the list. So, beta, taken over meaning purchased. Akash Ganga have purchased assets and liabilities at this value. This will form part of your balance sheet. Let us check each and every item one by one. What will be your total other current assets? 57,60,000 plus 1 crore 34,40,000. This will give you 192. Yes, these are your intangible assets which we discussed. 1 crore 92 lakhs of other current assets. Bifurcation is given in notes to accounts which we can see. 57 and 134 will give you 192. Property, plant and equipment 68 and 136. 68 and 136 total 204 will form part of your assets 204. After that, what other liabilities are taken over? Secured liabilities 2560 and 144. Here I will see my secured liabilities 2560 and 144, 169.60, and even unsecured loans are taken over at 43 lakhs. Here I have written unsecured loans too. All the remaining three are short-term liabilities. Trade payables 4480 and 2880. Yes, 4480, 2880. Statutory liabilities 144 and 20 lakhs. Statutory liabilities 144 and 20 lakhs, total 164. These are your balance sheet items, you can check it. Acha madam, what about this employee liabilities? Beta, this has been taken over and even settled by issue of equity shares. So we have given effect of this in equity shares. Now, have we tick marked all the items? Ideally, yes. We have considered each and everything. So your balance sheet must tally, but do not forget important part that you have received cash. Cash is received against what? Against issue of equity share capital. So you will get cash too. Yes, these are the totals, individual amounts we have found out. This is your amalgamation big sum given in the chapter, RTP. I hope you have understood this. What was the new point? New point was that PC is not there for equity shares. Reason being, equity shares gave money, that to 40 lakh rupees, to get the new shares of new company. Clear? Yes. Preference shares were given. So that is your question number 6. Done? Okay. Yes. So let us start with our next sum. Next sum is based on another chapter, internal reconstruction of a company. In internal reconstruction, we prepare a new account, a separate account, a specific account. And which account is that? That account is your reconstruction account. All your entries are routed through that account, correct beta? When a company is internally trying to reconstruct its business. So here is your question. Z Limited provides you the following information as on 31st March 2021. Share capital. You have 5 lakh equity shares of 10 each, fully paid up 50 lakhs. You have 20,000 preference shares of 100 each, fully paid up 20 lakhs. Reserves and surplus. Profit and loss, debit balance 14,60,000. Now what does this represent? This is your loss. And we know even if nothing is mentioned in the sum, this needs to be written off. Further, non-current liabilities are 10% secured debenture 16 lakhs. Current liabilities are interest due on debenture, trade payables, loan from directors, bank OD, provision for tax. Coming to your assets, land and building is tangible asset, plant and machinery is tangible asset, furniture and fixtures are also tangible assets. Intangible assets are goodwill. What are you supposed to do with this? Even if nothing is mentioned, I will write off my intangibles. Current assets are trade investment, and trade receivables and inventories. Let us read each and every point and see what the journal entries of these will be. First, preference dividend is in arrears for last 2 years. So beta, if something is mentioned about this, then I'll have to pay off the preference dividend. A simple question, is preference dividend shown as a liability on the liability side? Then the answer is no, which means it is not a recorded liability, it is a contingent liability. If a contingent liability gets cancelled, then according to our rules, no entry will be passed because it was never a liability and it got cancelled. The recorded balance sheet value is 0. So, no entry at all. But if contingent liability is settled, then you will have to pass one entry for it. Let us see. Mr. Y holds 60% of debentures and Mr. Z holds 40% of debentures. Okay. So, there are two parties, Mr. Y and Z. What do they have? They have debentures. Okay. Mr. Y holds 60%. Total value of debentures given in the sum is 16 lakh rupees. So, 60% of 16 lakhs and 40% of 16 lakhs will give you 9,60,000 and 6,40,000. If you read the sum carefully, not just debentures, but you even have interest on debentures. See, 10% of 16 lakhs comes to 160. Now, if entire debentures are held by two parties, then even the interest will belong to those two parties. Here, interest on debentures will be 96,000 and 64,000. Next. Moreover, rupees 1 lakh and 60,000 were also payable to Y and Z respectively as trade payables. Okay. So, trade payables 1 lakh to Y and 60,000 to Z. These are all your liabilities. Further, the following scheme of reconstruction has been agreed upon and duly approved. All the equity shares are to be converted into fully paid up equity share of rupees 5 each. So, the face value of the new share is going to be 5 rupees, since they are saying that 5 rupees is going to be fully paid up. When do we call a share to be fully paid up? When face value and paid up value are same? That means this sum is as per reducing your face value as well as paid up value. Replacement entry will be passed. Now, beta, what is the journal entry to be passed? Check your original value of equity share, 50 lakh rupees. How many shares? 5 lakh shares of 10 each. Now, it will be 5 lakh shares of 5 each. Journal entry will be, this as credit balance, I will debit it. Equity shares of rupees 10 each, 50 lakh debit. To equity share capital, face value 5, 25 lakhs. And the balance is your benefit, your profit. So, profits should be credited. Credit all incomes and gains. So, to reconstruction account, 25 lakhs. Where do you transfer all your profits and gains? To your reconstruction account. What is the journal entry form? Equity share capital 10 to equity share capital 5 to reconstruction. 50 lakhs, 25 lakhs, 25 lakhs. Is it clear to everyone? Yes. Next. The preference shares are reduced to 50 each, and the preference shareholders agreed to forgo their arrears of preference dividend. So, beta, arrears of preference dividend are not to be paid. What is their balance sheet value? 0, because they are reflected in the footnote, contingent. So, beta, if balance sheet value is 0, that means you do not have to pay anything and it is cancelled. So, no entry. But what is the condition of foregoing the shares? The condition is that their 9% shares shall be converted to 10% shares. Okay. Everyone come to your balance sheet over here. 9%, 20,000 preference shares of 100 each fully paid up, 20 lakh rupees. What am I going to do? Here I will write 9% preference share capital is gone of 10 each. Instead, I issued 10% preference share capital of 5 each, and the balance shall be transferred to reconstruction account. Amounts will be 20 lakhs, 10 lakhs, 10 lakhs. Clear? Let us see the solution. First, equity share capital 10, 50 lakhs. To equity share capital, face value 5. To reconstruction account, 25 lakhs. Okay. Second entry is 9% preference shares, 20 lakhs. To 10% preference shares, 10 lakhs. And to reconstruction account, 10 lakhs. Fair? Next. Third point. Mr. Y and Mr. Z agreed to cancel 50% each of their respective total debts, including interest on debentures. They want to cancel 50% of their claim. They are also ready to pay 1,60,000 respectively in cash. So, beta, when cash is coming in for the company, we say debit what comes in, cash account shall also be debited. And what do they want to receive in return? Then it has been said that they want to receive 12% preference shares for the balance amount, meaning for the balance 50%. So here we have already mentioned that their debts are 960, 96 and 1 lakhs for Y, and debts for Z are 6 lakh 40, 64 and 60. Now beta, all the debts have credit balance. Okay. Your total debts shall be, if you calculate 9,60,000 plus 96,000 plus 1 lakh will give you total debt of 11,56,000. And here it will be 6,40,000 plus 64 plus 60, 7,64,000. They are ready to waive 50% of their debt, 50% waived off. So 50% will come to 3,82,000 for Z, 5,78,000 for Y. Correct? With me? Okay. Now let us see the journal entry. When all the debts are cancelled, debts have credit balance, they shall be debited. Journal entry will be 10% secured debentures account debit 9,60,000, this value. 1 lakh rupees of trade payables and 96,000 of interest on debentures, we have considered all these values. Plus, Y was ready to give us some cash too. What amount of cash? I told you cash will be debited. Cash bank 1 lakh rupees. And they want to cancel or waive 50% of the debt, which is 5,78,000. When they are waiving, this will be transferred to reconstruction. And for the balancing figure, they want 12% debentures to be issued. Yes. Similarly, for Z, 10% secured debentures are cancelled, debited. Trade payables of 60,000 are cancelled, debited. Interest on debenture of 64,000 is cancelled, debited. Cash is received, 60,000 debit. And in return, they want to cancel 3,82,000. They are ready to waive off 3,82,000. That is our profit. Credit all income, 382. And for the balance, I have to issue them 12% debentures. So I hope these two entries are also clear. Yes, let us see the next point. Persons relating to trade payable other than Y and Z also agreed to forgo 50% of their claims. So, other trade payables other than Y and Z, let us see what is the total value of trade payables. Trade payables total value is 5 lakh rupees. Out of 5 lakhs, bacha, out of 5 lakhs, 1 lakh and 60,000. Total 3,40,000 are other trade payables, and other trade payables agreed to forgo 50% of their claim, which will come to 1,70,000. So liability is getting reduced. Liability should be debited and reduction or reconstruction account should be credited. Trade payables to reconstruction, 50% claim. If you want, you can show 5 lakh minus 1 lakh minus 60,000, 50%. Next, Directors waived 60% of their loan and accepted equity shares for the balance. For the balance, 40%. So, but a director's liability is also your liability having credit balance, which shall be debited. They want to forgo 60% of claim. So 1 lakh 60% is 60,000, and for the balance, equity shares of 5 rupees each shall be issued. Where was the liability shown? Beta, it was clearly shown over here. Loan from directors, 1 lakh rupees. Okay, next. Capital commitment of 3 lakh rupees were cancelled on payment of 15,000 as penalty. Now, can you see capital commitment anywhere in the balance sheet? No. But in order to cancel that, you have to pay a penalty. So, penalty is one of the expenses that we have to incur. We have to pay bank. So, to bank. And what will we debit? Reconstruction expenses. Reconstruction expense to bank. Okay, we do not write penalty to bank, because at the end of the day, penalty is an expense which will be transferred to P&L, and P&L has to be transferred to reconstruction. So directly write it off against reconstruction right now. Okay, next. Directors refunded 1 lakh of the fees previously received by them. So initially we paid them some fees of 1 lakh rupees. Now they are refunding it. So can I say cash for me is coming in? Cash bank account debit 1 lakh. 2. Directors fees, no beta, we are not creating a liability. They are refunding it. It is a profit for us. And in that case, what am I going to credit? Reconstruction expense. Not expense, reconstruction account. 1 lakh. Yes? Okay. After that, reconstruction expenses paid were 15,000. Reconstruction expenses should be debited to bank account. So my journal entry will be reconstruction account debit to bank account 15,000 rupees. Next. The taxation liability of the company was settled for 75,000 and was paid immediately. Now please come to your question and check, do you have provision for tax? Then the answer is yes. We expected a liability of 1 lakh will arise, but we realized that out of 1 lakh, we are supposed to pay only 75,000, which means 25,000 is the benefit in a way received by us. Okay, so how are we going to show that? Liability of 1 lakh shall get cancelled by payment only of 75, which means balance 25 will be your benefit reconstruction account. Yes, next. The assets were revalued as under. Land and building is supposed to be revalued at 32 lakhs. Please come to your question. Land and building is 30. Can I say upward revaluation? Whenever there is upward revaluation, land will be further debited and we will credit what? Our new account, reconstruction account. So land account debit to reconstruction only by the balancing figure of 2 lakh rupees. Okay, after that, plant and machinery 6 lakh, inventory 7 lakh 50. I have to bring plant and machinery to 6 lakh. Right now the value is 12 lakh 50. So there is a downward revaluation. In that case, what are we going to do? Plant and machinery will be credited. What should I debit? Reconstruction expense. I can pass one combined entry. Reconstruction account debit. 2. Let us see plant and machinery 6 lakh 50. One thing at a time. After that, next item given is inventory should be brought at 7 lakh 50. What is the present value of inventory? 10 lakhs. So I'll have to reduce it by 2 lakh 50,000. 10 lakh debit. I want it to be 750 debit. So I will credit it by 250. Next item given is 4 lakh rupees should be the value of trade receivable. Okay, trade receivable given over here is 5 lakhs. Bring it down to 4 lakh, that is revalue it by 1 lakh, downward revaluation. So over here trade receivables 1 lakh. Furniture and fixture 1 lakh 50. Trade investment 450. Okay. Furniture and fixture is 250. I want to bring it at 150. I will revalue it by 1 lakh downward. Here 1 lakh downwards. And trade investment 5 lakh. Value is 5 lakh and we want to bring it at 4 lakh 50,000. So what am I going to do? Trade investment will be revalued by 50. Now, beta, I told you that even if not mentioned in the question, I need to do what? I need to remove or write off my P&L account. P&L account also has debit balance. I want to erase it. I am going to credit P&L by 1460. And so will I credit my intangible assets by 11 and 5 lakhs. I had two intangible assets in the sum, which we have clearly shown over here, 11 and 5 lakhs. Okay. Now, if there is any balance left in reconstruction account, what will I do with it? I will transfer it to capital reserve. That is your profit of 7,75,000. Yes, for that we can even create one account. This is going to be your balancing figure. What have you done in your account? We have just posted all the balances. Okay. Also, question has prepared, your IC has prepared your bank account. You will show all your bank balances over here. Yes, it will start with bank OD of 1 lakh. Eventually, you will receive the money. You have received it from whom? From your two debenture holders, 1,60,000. Yes, after that, you have paid certain expenses. You have received some amount from your directors. All those are shown over here. Reconstruction expenses, that is penalty was paid. Amount was received from directors. Your basic expenses were paid. Taxes are paid and your balancing figure comes to 55,000. Clear? Yes. What have they asked you to do? This is it. You are required to pass journal entries. We just now saw for all the above mentioned transactions, including the amount to be written off for goodwill, patent and P&L account. They have clearly mentioned. Also prepare bank account and reconstruction account. They have asked us to prepare these two accounts, so we have done it. Yes. Once your entries are there, you just need to post it. Your accounts will be ready. Easy sum. Okay. No difficult adjustments were there. Now, your next chapter is regarding liquidation of companies. Okay. So, they have given you the balance sheet of Cloud Limited as at 31st March 21, being the date of voluntary winding up is as under. Equity and liabilities. Shareholders' funds are share capital of 21 lakhs, reserves and surplus of 4 lakhs. Your non-current liabilities includes long-term borrowings of 4,20,000. Current liabilities include short-term borrowings, trade payables and other current liabilities. You have to pay all of them. Asset includes property, plant and equipment. Now beta, we are in which chapter? Liquidation. We need to sell all these assets, including current assets. Inventories will be sold, money will be recovered from trade receivable and you already have cash and cash balance 0. Okay, next. In notes to accounts, they have given you detailed information. Let us see the first note. Share capital. Authorized. 10,000 shares of 100 each are authorized and 10,000 equity shares of 100 each are again authorized. 10,000, 10% cumulative shares of 100 each are authorized. Okay. Issued, subscribed and paid up. Out of the first 10,000 shares which are authorized, you have issued the entire number of shares, but only 60 is paid up. And on the second type, only 50 is paid up. Now you must have learned, beta, when your paid up values are not same, we need to bring all the equity shares at par. Why? Because during liquidation, all the equity shareholders bear same amount of loss. Your final losses will be same. Correct? That means I have to make sure all of them will come at par. How will I do that? Let us see. We will use some adjustments to do this, some working notes. Reserves and surplus include securities premium of 15 lakhs and P&L debit balance of 11 lakhs. Long-term borrowings includes 10% debenture of 420. Short-term borrowings includes bank OD of 970. Other current liabilities have preferential creditors of 2,10,000. Property, plant and equipment are these figures. Preference dividend is in arrears for 3 years. Now, you have to pay this during liquidation, correct? And up to 31st March 21, these figures are given. When will you pay this arrears amount? Together with the capital, and we pay that at the end, after paying all the outsiders but before paying your equity shareholders. The assets realized as follows. But when you sold the assets from land and building, you got 1240. From plant and machinery you got 1420, from inventory 620, and from trade receivables 13,20,000. So let us take the total. 12,40,000 plus 14,20,000 plus 13,20,000 and plus 6,20,000 will together give you 46 lakh rupees. Here 46 lakhs is your total amount of receipts before considering the call money. Have you added call money yet? No, I have just added money received from all my assets. Next, they have mentioned liquidation expenses are 172. Okay, I'll pay that first. Remuneration of liquidator is 2% of the realization of assets. We just now found out realization of assets. 2% of that shall be liquidator's remuneration. Income tax payable is considered as preferential creditors. But you will say, ma'am, we already had preferential creditors of 210. Yes, beta. Over and above this, you have preferential creditors in the heading income tax payable of 134. Interest on debentures for the year ended 31st March 21 have not been considered in the balance sheet given above and has to be paid. So when will you pay this interest? Together with payment of debenture holders claim. Prepare liquidator's statement of accounts. Let us see. Now, do we have any secured liability? You have share capital, you have reserves and surplus. Under long-term borrowings, you have debentures, and these are normally on floating charge. Short-term borrowings includes bank OD, which is also unsecured. Other current liabilities are just preferential, and then you have your assets. Even if you see your balance sheet over here, you do not have anything specifically mentioned as secured liability. So basically we do not have secured. What will we do? We will consider in our liquidator's final statement of affairs on the debit side. First normally comes cash bank, which is 0 for us. So second will be amount realized from sundry assets. I'll consider all the assets over here as all the assets are available for all the liabilities. None of them were given as security. 46. I do not know about this amount yet. We will find it out in some time. Coming to my payments, whom am I supposed to pay first? Ideally, first legal expenses are to be paid, court expenses, but nothing is mentioned in the sum, so that is nil. After that, we pay liquidator's remuneration. Now, liquidator's remuneration was said to be 2% of the amount of assets realized, which we just calculated 46, and 2% of 46 comes to 92,000. After that, you will have your liquidation expenses, which was straight away given in the sum, 1,72,000. Now comes all your recorded liabilities. Whom do we pay first? We first pay secured creditors, which we do not have. After secured, we will pay preferential creditors. The name itself says that preference is to be given to them. So, but I discussed there are two preferential creditors. As per balance sheet, it is 2,10,000, and over and above balance sheet, they have mentioned that 1,34,000 is income tax liability. So, that is again preferential. After preferential, we pay debenture holders having floating charge on all the assets. I am going to pay 4,20,000 rupees of their face value, which was given to me in the question over here. 4,20,000 represents your debentures. But beta, if you remember, they have mentioned in the last line over here, yes, interest on debenture for the year ended 31st March 2021 has not been considered in the given balance sheet and is supposed to be paid. So now, if you see your percentage, it is 10% on 4,20,000, which will give you 42,000 is supposed to be paid together with 420. We have done that. After completing this, you will be paying your unsecured creditors. Now, which all unsecured creditors do you have? If you come to your balance sheet, you will come to know. You have your short-term borrowings, you have your trade payables, other current liabilities. Let us say out of these, which all will be considered under unsecured. Short-term borrowings, bank OD 970. They have considered bank OD of 970. We have preferential creditors, which are already considered. Okay, so will you consider it again? No. So now what is left? only 12 lakh rupees of trade payables are left, I will consider that too. Basically, out of 3, only 2 are considered. These are my preferential creditors. Okay, proceeding further. After all the outside liabilities are paid, whom are we supposed to pay? We are supposed to pay our owners. Even under owners, we are supposed to pay first preference shareholders and then equity shareholders. What is the total amount payable to preference shareholders? I have to pay them their capital as well as their dividend for 3 years. Coming to my question, all these liabilities are paid. 21 lakhs. Out of 21 lakhs, preference shares are of 10 lakhs and their dividend rate is 10%. So 1 lakh rupees is per year's dividend. Likewise, I have to pay dividend for 3 years. So total amount will be 10 lakhs capital and 3 lakhs of dividend. Are you all with me now? Yes. Coming to equity, I cannot directly pay my equity. Why? Because I have 2 different class of equity shares. And I want to make sure that at the end, all the equity shares bear same amount of loss. How are we supposed to do that? By making notional call. How do we do that? Let us see. Now tell me, what was the total cash available before making a call? 46 lakhs. And out of this 46 lakhs, you have made all these payments. Start taking the total. You will realize you have paid 92,000, 172, 420, 42, 2 lakh 10, 134, 970. What are all these things? But these are all the expenses we just now discussed except equity shares. Total amount paid is 45 lakh 40,000. That means balance available for equity is only 60,000 rupees. Correct. Now, with the help of this balance, we are going to find out our amount. Yes, I am on my question based on liquidation. Balance available for equity is only 60,000. I would have straight away divided this with my total number of shares, provided I had only 1 class of equity shares. But since I have 2 class of equity shares, what am I going to do? I am going to add notional call. Now what do you mean by the term notional meaning? Notional meaning fake, bogus. Are you actually going to make this call? Maybe, may not be. We do not know right now. We are right now just making a notional call. We are checking if we call the amount, what will be our case? Yes? Achha. Come to your question again. You have 10,000 shares of 60 each and 10,000 shares of 50 each. I will make sure that all my shares come at par. In order to bring them at par, what will I do? I'll convert my 50 rupees share to 60 rupees share. In order to convert them from 50 to 60, can I say I need to make a call of 10 rupees per share? What are the total number of shares? 10,000. So here you will say notional call will be 10,000 shares into rupees 10 per share, which will give you 1 lakh rupees. That means your total value now will be 1,60,000. At this point of time, I can say I have total 160 and totally I have 20,000 equity shares of rupees 100 each, comma 60 paid up. Which means what did we just now do? We converted all our equity shares into 1 class of shares. Is this actual refund available? No, this is your notional refund available. So beta, what is your notional refund per share? Notional refund per share shall be 1,60,000 divided by 20,000, which will be rupees 8 per share. Correct. Now, I have 2 different class of shares. First are 10,000. Second are also 10,000 shares. Okay. For the first class, what is the call amount demanded? Notional call. But what is the notional call demanded? From first class of shares, these one, I did not demand any money, 0. And from the second class of shares, I demanded 10 rupees. Okay. What is the notional refund that I am planning to give them? I am planning to give them rupees 8 per share. So but now I need to find out my actual call or actual refund. How to do that? Whichever is heavy will be your answer. For first class, 0 is my call, 8 is my refund. Can I say refund is heavy? So you will have actual refund of 8 rupees. For the second one, you are going to make a call of 10 and then you will give them refund of 8. But first you will demand 10 and then you will give refund of 8. Rather, why not just make a net call of 2 rupees per share? Correct? Yes. Madam, please prove that at the end their losses are same. Okay. But what are their paid up values? For first class of 10,000 shares, their paid up value was 60. And for the second class of 10,000 shares, their actual paid up value is 50. Have you made any call from them? Yes. For the first class, it is refund, so no call. And for the second class, I am going to demand 2 rupees. Okay. Are you giving them any refund? Yes. To the first one, I am ready to give 8 rupees refund. I am talking about actual, okay? And second one, nothing. So, out of total amount paid in the company 60, if you are my shareholder, you have paid me 60 rupees and I am going to refund you only 8. That means for you 52 is loss. And for the second class of shares, they have paid me till date 50, I am demanding 2 more. So again 52 is my loss. But their loss remains same. That is my final agenda. Got it? So what is the actual refund per share? 8 rupees. And what is the actual call per share from second class of equity shares? 2. So 10,000 into 2 will give me 20,000 rupees actual call. On the receipt side, call from shareholders, call money is 10,000 shares on equity shares which were rupees 50 paid up. I am going to demand 2 more rupees. And by equity shares, I am going to give refund to 10,000 shares which were 60 paid up, rupees 8 per share. That will give me 80,000. This is how my account tallies. I hope this is clear to everyone. Yes? Any doubts? Okay. I hope it is clear, beta. Coming to my next part. This was quite a simple sum. Okay, bachas. So the next chapter that we have is NBFC. This is quite a small and simple chapter. Yes. What have they asked you? They have given you 2 questions. First says, calculate own funds of NBFC based on the following information. Now, beta, you have to find out your net own funds, gross own funds. Let us see what all information is given. Now, own funds includes your share capital. Which type of share capital? Beta, equity. And it includes those preference shares which are going to get converted into equity. So, only preferences are not to be considered, only convertible preferences will be considered. You are going to consider all your free reserves excluding revaluation reserve. If you have any intangible assets, then you should remove them. This is how you find out your basic own funds. Yes, let us see what information is provided. First, paid up share capital of 200 lakhs is given, which I will consider in calculation of own funds. Free reserves of 150 is there, which again I'll consider in calculation of own funds. So 200 plus 150 is 350. Compulsory convertible preference shares of 50 lakhs. Will we consider this? Definitely we will consider this because they are going to get converted into equity. Check, they have considered 200, 150 as well as 50. Revaluation reserve shall not be considered. Not to be considered. Okay, next you have securities premium of 25 lakhs, which is again considered. Book value of intangible assets shall be subtracted after taking the total. And you are going to consider your capital reserve surplus arising out of sale proceeds of assets of 15 lakhs. I shall consider that. Okay, after you add up all these values, your net value right now is 440 after just adding all the stuff. And from that, what am I going to subtract? I am going to subtract my intangibles of 10 lakhs, which after I will get my own funds of 430 lakhs. Yes, total of all the items is 440, which has to be reduced by intangibles of 10, therefore net own funds is 430. Quite a simple sum, can be expected for 5 marks. Coming to your next part, which is calculation of provision. Now beta, in calculation of provision, you need to realize whether your sum is based on systematically important NBFC or non-systematically important NBFC. Why so? Because the percentage of provision of standard asset is different. If it is systematically important, then the percentage will be different, that is 0.4. And if the sum is based on non-systematically important, then your percentage of provision of standard asset will be 0.25. Remaining all the assets, percentages are same whether the sum is based on systematic or non-systematically important company. Let us see what is asked. While closing its books of accounts for the year ended, NBFC has its advances classified as follows. Standard assets 1,26,000. I need to know what kind of company it is. After that I will write it. Substandard assets will be done at 10%. Provision of 10% shall be created. Secured portion of doubtful debts up to 1 year, you will charge 20%. 1 to 3 years, 30%. More than 3 years, 50%. If your doubtful debts are unsecured, then 100%. And if you have loss asset, they are loss, 100%. Okay, so the only point missing is standard. Let us read. Calculate the amount of provision which must be made against the advances as per NBFC, which is non-systematically important non-deposit taking. If it is non-systematically important, I am going to charge 0.25%. You have all your amounts, rupees and lakhs. So I'll be preparing 4 columns. First will be name of the asset, second will be rupees and lakhs, third one will be percentage of provision, and the fourth one will be product of second and third column, that is provision in rupees. Here you have the solution. Standard assets 126.25%, substandard asset 10%, secured portion of doubtful debts 20, up to 1 year 20, 1 to 3 years 30, more than 3 years 50, unsecured portion of doubtful 100, and loss asset also 100. You will get your amount. Quite a simple sum, can be expected for 5 marks. Yes, beta? I hope there are no queries in this sum. Next is one of your important chapters, banking companies. Now, you have so many small concepts in banking companies, and then you have full-fledged sums. What have they asked you in current sum? But in current sum, they want you to prepare P&L account of Star Bank Limited. For that, they have given you certain information. Let us check each and every item. Before that, let us recollect together what was the P&L format of banks. First, you have incomes, which include 2 incomes, interest earned and other incomes. We then have our expenses. Expenses will include interest expended, operating expenses, and provisions and contingencies. What do we have next? Beta, income minus expense will give you profit and loss. First is profit or loss for the year, and second will be profit or loss brought forward, that is your opening balance for the year. This will give you your total profits, and this profits needs to be appropriated. First, you will transfer some amount to statutory reserve. Transfer to statutory reserve. It has to be at least 20%, and then depends upon your question. Second will be transfer to other reserves, transfer to government or proposed dividend, and balance shall be transfer to balance sheet, or you can call it as balance carried over to balance sheet. But your total of P&L should be same as appropriation. Here I am going to take my total of incomes as A, total of expense as B, P&L shall be C, and here C should be equal to D. Okay, whatever you earn is the amount that you are going to distribute, that is a portion. Let us read the question. Do you remember we have certain schedule numbers? I hope you remember all the schedule numbers. For interest earned, it is schedule number 13. Other incomes, it is 14. Interest expended 15 and operating expenses 16. This will be as per your working note. Now, I am reading each and every point and I will decide which point will go under which schedule. Interest and discount received, that is earned, 13. Interest is paid on deposit, expended, 15. Salaries and allowances are your operating expenses, 16. Directors' fees and allowances, 16. Rents and taxes paid, 16. Postage, 16. Statutory reserve fund is a fund given, we will see. Commission, exchange and brokerage earned, it is income. But is it interest income? No, it is other income, 14. Rent is received, again other income, 14. Profit on sale of investment is again other income, 14. Depreciation on assets are your expenses, normal expenses, 16. Statutory expenses, 16. Preliminary expenses, 16. Auditor's fee, 16. Favorite part of all the students, 16. Yes, chalo. The following further information is also available. Issued and subscribed capital of the bank is 40 lakh rupees. Okay. Preliminary expenses are to be written off during the year, meaning transfer to schedule 16. Important. Rebate on bills discounted. Beta, what do you mean by ROBD, rebate on bills discounted? Money received in advance. So what are they saying? ROBD was 60,000 as on 31st March 20 and right now it is 80,000 as on 31st March 21. Meaning last year we received some money in advance, 60,000. So in last year we would have said, sir, this belongs to next year. Now we are in that year. So I will add this 60,000 to my current year. And in current year I have received 80,000 in advance which belongs to my coming year. So I will remove it from my books. From where beta? From your discounts. And where are discounts included? In your first item, interest and discount received, that is schedule 13. So let us see our schedule over here. Schedule 13 is as per working note 2. Working note 2 says interest and discount received 1 crore 52 lakh 640 rupees. I have mentioned this over here. Your adjustment 3 says opening ROBD is 60,000, that is last year's, it has to be added and current year's shall be subtracted. Your net balance will be 1 crore 51 lakh 80,000 640. This will be your amount of schedule 13. Okay, next. Transfers specifically mention 25% of profits to statutory reserve. If they have specifically mentioned it, I will follow that. If nothing would have been mentioned, I would have transferred 20%. Income tax of 8 lakhs is to be provided. Okay, we will add 8 lakh rupees. Where? To our expenses. Provisions. Provision for income tax, 8 lakh rupees. Next, Mr. G, a customer of bank who had taken an advance of 40 lakh rupees from the bank became insolvent and only 25% was expected to be recovered from his estate. So basically, can I say 75% is doubtful to be received? Doubtful to be received. Which means I need to create a provision for the same. What is such provision called as? If he is an advance, I have given him advance, which means he is my debtor. And if he is my debtor, I will charge RDD on this. Clearly mentioned, 75% is doubtful. 75% of 4 lakhs comes to 30 lakh rupees. I will show it under the heading provisions. Provision on advance to Mr. G. Okay, next. considered. A provision of 8 lakhs was necessary on other debt. This is your normal RDD on other debts. 8 lakh rupees, I am going to create provision of this amount. Next. There was no opening balance in P&L account. So beta over here, P&L brought forward will be nil in our case. Yes, have they shown it as nil over here? Please check. Yes, this has been shown as nil. Profit brought forward, it has been shown as nil. Okay, next. You are required to prepare P&L account and schedule of profit and loss accounts of Star Bank for the year ended 31st March 21. Also show how profit and loss will appear in the balance sheet. This is just a specific note to be mentioned at the end. Basically, what I want is P&L account. So beta, which other points will be there? No other points. I am just going to give effects of all these items. Yes, individually you will be showing all these items in your books. Let us see, have they shown each and every of them or not? Will you show issued and subscribed capital anywhere in your balance sheet? No, that will be part of your balance sheet, not part of your P&L. Preliminary expenses of the are to be written off and will be transferred to 16 schedule 1,20,000. Just check in your schedule number 16, are all these expenses included? 10 lakhs, 140, 4 lakh, 261, 360, 160, 152, 120 and 48,000. If you check over here, you have a list of all the expenses which includes all these items mentioned by me just now. Okay, schedule 16 is done. Coming to schedule number 13, I have made the changes. Schedule number 15 includes 91,81,440 rupees. If you check your schedule 13 over here, 91,81,440 rupees. Next, commission received, rent received and profit on sale of investment will be these amounts: 760, 9,03,200 and 2,88,000 as it is. Now statutory reserve fund is your till dates reserve fund. This will again be part of your reserves and surplus balance sheet, not in P&L, so I will not give any effect of this. I have considered point 1, I have written off preliminary expenses, ROBDs considered. This will be done in a minute. There was no opening balance considered. So basically, if you understand beta, I have considered all my schedules. All I have to do is take the total. Once my totals are ready, what will I do? I'll start posting the amounts in my P&L account. Your total of income comes to 1,71,31,840. Expenses are 1,60,62,800. That will give you your current year profits, and 25% of current year profits will be transferred to statutory reserve. What about the balance? Balance shall be carried forward to balance sheet because this total will be the same. A very simple sum. All you have to know is no effect will be given of these 2 points which I am highlighting: issued and subscribed capital and statutory reserve fund. Next, here a note has been mentioned which we require. P&L account of 8,01,750, that is the one just we found right now, will appear under the heading reserves and surplus in schedule 2 of balance sheet. They just asked you where will it be shown and how will it be shown. We have given a note on that. Understood beta? Yes, this was your question number 10. So now let us start our next sum, that is based on consolidated financial statements. A very small sum has been asked. From the following information of Beta Limited and its subsidiary Gamma Limited drawn up at 31st March 2021, prepare consolidated balance sheets as at that date. But which is the subsidiary company? Gamma is the subsidiary company, meaning Beta is the holding company. Now, when we prepare consolidated financial statements, who will prepare that? It will be prepared in the books of Beta Limited. Your consolidated balance sheet of Beta Limited and its subsidiary Gamma as on 31st March 2011. What all information is given? First of all, they have given share capital, shares of rupees 100 each, 15 lakhs and 2,50,000. One thing is very clear. Will you show shares of Gamma Limited in your new balance sheet? Then the answer is no. It will be distributed between your cost of control and minority interest. So in my consolidated balance sheet, only 15 lakh rupees will be seen under share capital. Next, under the heading reserves and surplus, first are general reserves. I will show this under consolidated reserves and surplus, and this 1,87,500 will be distributed between cost of control, minority interest and consolidated reserves. Pre part will go to cost of control. Our post part, who are we? Beta, our post part will go to consolidated reserve and minority interest will be shown separately. Profit and loss account, the one that is of Beta Limited 2,50,000 will be completely part of consolidated reserve, and for the subsidiary company, again some part will go to cost of control, some other will go to minority interest, and post period profits will be added to your consolidated reserves. Trade payables, straight away I'll take the total 3,75,000 and 1,42,500. Property, plant and equipment, bacha, this is important in our sum. Other non-current assets, 11 lakh and 3,75,000 you can straight away show. Non-current investment, shares in Gamma Limited, how many shares are purchased? 2,000 shares at rupees 200 each. Total investment value is 4 lakh rupees, and where will you transfer this? To cost of control. Now, bacha, what is your percentage of holding? If at all you see, total share capital of Gamma is 2,50,000 rupees and each share is of 100, which gives 2,500 shares. And out of 2,500 shares, 2,000 shares are purchased by Beta. So, bacha, 4/5 is purchased by Beta. 4/5 is nothing but 80% holding in the company. This shows 80% holding, you can confirm that. Further, other information. Reserves and surplus and P&L account of Gamma Limited stood at 62,500 and 37,500 respectively on the date of acquisition of its 80% shares by Beta. Beta, when is your date of acquisition? 1st April 20, and the balance sheet over here is asked for which date? 31st March 21. That means, can I say start of the year is itself your date of acquisition? Yes. So all the transactions that happened for the whole year will be completely post in case of Gamma. Next, important point. Machinery whose book value was 2,50,000 and furniture whose book value was 50,000 rupees of Gamma Limited were revalued at 3,75,000 and 37,500 respectively. On which date, beta? On first day of the year, that is on date of acquisition, for the purpose of fixing the price of the shares. So before Beta could come and take the equity shares of Gamma, Gamma revalued its assets and furnitures and machinery, which means this will give rise to revaluation reserve, and this reserve was created before the shares were purchased. How do we know? Because it has been mentioned that this has been valued in order to fix the price of the shares purchased. So, but a completely revaluation reserve shall be post. But the point to be noted or to be understood is that if assets will change, then its depreciation will also change. And if depreciation will change, then it will have impact on profits and losses earned during the year. A very simple question. Whose assets are changing, beta? Gamma Limited's. So whose profit will be affected? Profit of Gamma, that is 62,500, will have some changes in it. Let us see what is the amount. Further, they have said rates of depreciation computed on the basis of useful lives is for machinery 10% and furniture 15%. These are the percentages calculated. Yes. Now beta, take your calcies. Book value was 2,50,000 for machinery. So for the whole year, I would have charged 10%, that is 25,000. And at the end of the year, my value of machinery will be 2,25,000. Can you all see the one that I'm highlighting in green color right now? 2,25,000. How did we arrive to this value? Initially, at the start of the year, 1st April, it was 2,50,000, and for the whole year, 25,000 rupees were charged. For furniture, initial book value was 50,000. And on this, depreciation of 15% is charged. 50,000 into 15% will give you 7,500. Thus, you will arrive at your WDV of 42,500 rupees. I hope this is understood. Now, my question is, these are new values or old values? These are old values because 2,50,000 was old book value. Have they revalued it? No. Which means revaluation effects needs to be provided by us. Let us see each and every reserve individually and find out the balance. Also, let us find out in cost of control whether we are getting capital reserve or goodwill. One thing at a time. Okay, starting with my basic reserves. Beta, what is the closing balance of basic reserve? 1,87,500, which means reserves of gamma $1,87,500. This is as on 31st March 21. Beta, what was the amount of reserves on 1st April 20? That is opening balance, and the remaining part will be earned during the year, current year income or current year profits. Let us see. It has been mentioned that reserves were 62,500 at the start of the year on 1st April 20. So 62,500. What will be your balance of profits earned during the year? 187,500 minus 62,500 shall give you 1,25,000. Now what to do with this beta? Reserves, opening balance should be distributed between holding company. Who is our holding company? Beta Limited, and minority interest. In what percentage or what ratio? 80% and 20%. Correct? Now 62,500 into 80% will give you 50,000 and 12,500. Tell me, where will you transfer what? This 50,000 is of which period? It belongs to opening balance, and opening balance is basically profits earned in previous year. Previous year is 1920. Beta, was Beta Limited shareholder of Gamma Limited in 1920? Then the answer is no. That means this balance of 62,500 was entirely earned by the old shareholders. This entire profit will be termed as pre-profit, and pre-profit needs to be transferred to cost of control. This will go to your minority interest. Coming to current period's profit. Now, current period's profit has been earned by Beta. So Beta will say 80% of 125 belongs to me, and the balance 20% belongs to minority interest. 1,25,000 into 80% will give you 1 lakh rupees and 25,000. Now minority interest shall go to minority interest. That is okay. What about current year profits? Beta, completely post. Why? Because my date of acquisition is 1st April 20. So it is completely post. And if at all Beta has worked to earn this profit, then Beta will say it should be added along with my profit. That means I will transfer this to consolidated reserves. I'll add it to my existing, that is Beta's existing reserves. Is it clear, everyone? So Beta, we have our reserves bifurcation here. Total minority interest will be 12,500 plus 25,000, 37,500 rupees. This is your bifurcation of reserves of 187,500. Just like this, we need to bifurcate P&L account too. But for P&L account, we know that there is some change. Now, in order to find out that some change, let us do our working of revaluation. Now, bacha, is the revaluation done upward or is it downward? Let us see. Revaluation of assets. Now, two assets are revalued. Working note 2. First, machinery. Machinery whose original book value was 2,50,000 is now valued at 3,75,000. Good. 2,50,000 is now valued at 3,75,000 new book value. That means you have upward revaluation by 1,25,000. Revaluation reserve upward will be 1,25,000 rupees in case of machinery. And for furniture, original book value of the furniture was 50,000 rupees and new book value is 37,500. Oh, so 50,000 has now become 37,500, meaning downward revaluation. So here you will get loss of 12,500 rupees. Therefore, net revaluation reserve should be how much? Net revaluation reserve will be 1,25,000 minus 12,500, which will give you 1,12,500. Now, beta, since it is a reserve, I will have to bifurcate it between pre and post. And can I say this is completely pre? Why? Because it was done before the shares were acquired, like we discussed before 2-3 minutes. Now, since we know it is completely pre-distributed between Beta Limited, your holding company, and minority interest, in which ratio? 80 is to 20. 1,12,500 into 80% will give me 90,000 and 20% will give you 22,500. Minority interest shall be transferred to minority interest, but pre-reserves will go to cost of control. I hope you remember this. Everyone, we have studied this. Next. Impact on depreciation and P&L account. So tell me, beta, what is your old depreciation value for machinery and for furniture? One asset at a time. So old value of machinery was 2,50,000, on which 10% depreciation charge. That means old depreciation was 25,000. When did you revalue? You revalued on first day. So for the whole year, new depreciation will be applicable. What is your new depreciation rate? Rate has remained the same of 10%, but your value has changed. Here it will be 3,75,000 into 10%. That will give you 37,500. So, beta, if depreciation will increase of depreciation by 12,500 will result in decrease in P&L account. When your expenses increase, profits shall decrease. Let us think about furniture. Initially, furniture was 50,000 rupees, and on 50,000, I have charged 7,500 as my old depre. Furniture now needs to be revalued at 37,500, and on that, if I have to charge, I will charge only 5,625 rupees. That means initially expenses were more, now expenses are less. The difference of 1,875 is in a way savings in depreciation, and because of the savings, my P&L will increase. Of which company, beta? Gamma Limited. I hope this is clear to everyone. Is there any doubt? I hope not. So, beta, what is your net effect on P&L? Net effect on P&L of Gamma Limited P&L has decreased by 12,500 and it has increased by 1875. So can I say there is net decrease in P&L by 10,625 rupees. Clear? Let us see the solution given by the ICAI. Chalo bachas. Here. Yes, so let us see how ICAI has presented it. ICAI has shown it in point number 4. Now, the changes of your depreciation will have effect on P&L in which period? In current year, and current year is entirely post period. So I will show it in my way, but I am just showing how it is presented by ICAI. Here, ICAI has added excess depreciation charged on furniture on 12,500, that is 1875 is added, which we also showed 1875. We have added it and we have subtracted 12,500. Here ICAI has subtracted 12,500. So let us present it properly now. P&L of gamma. According to my question, my total P&L, the first item over here, first line P&L of gamma is 62,500. This is as on the last date. Sum of this amount belongs to opening balance and the balance is current year profits earned. Now tell me, what is your total opening balance given in your question? In my question, it has been mentioned that total opening is 37,500 rupees. So here I am going to write 37,500 and opening shall be completely pre, whereas current year profits shall completely be post. If out of 62,500, 37,500 pertains to your opening, 25,000 pertains to my current year profits. Out of this current year profits, I will say less effect of depreciation. How much did we decide to reduce? Just now we saw in our previous working, net reduction, net decrease in P&L of gamma should be 10,625 rupees. I'll reduce this 10,625 from my 25,000. This will give me 14,375. Correct? Now, all we have to do is bifurcate your pre and post period profits between holding company Beta Limited and minority interest 80%, 20%. Beta and minority 80% and 20%. $11,500, 2,875, 30 and 7,500. Where will you transfer these items to? Let us see. 30,000 belongs to holding company and that too of pre-period shall be transferred to cost of control. 7,500 belongs to minority interest. 11,500 again belongs to holding company but for post period. That means Beta has earned this profit. It will transfer it to consolidated reserves and this will be shown as minority interest. Total P&L for minority interest will be 7,500 plus 2,875. This will give you 10,375. So how many reserves do we have in all? 3. One were your normal reserves, the one that I showed over here at the beginning. Second, revaluation reserve, which we calculated and bifurcated. And the third one we have is P&L of gamma. Let us see how our reserves in surplus and remaining all items will be shown in the new balance sheet. Beta, under the heading reserves and surplus, You will first have regular reserves of beta and gamma. For gamma, it will only be for post period. Then you will have your P&L account, again of beta and gamma, only post period. Now tell me beta, revaluation reserve, was there any balance in post for gamma? No. Do we have any revaluation reserve for beta? No. So we will not present it under heading reserves and surplus. Which one? Consolidated. One by one, let us post the figures. According to my question, here, what is the balance? 5 lakh rupees of beta for reserves, 5 lakhs. And for P&L, 2 lakh 50,000, 2 lakh 50,000. If I check my working, here, how much am I supposed to post in reserves of gamma? 1 lakh post period. It will be 1 lakh. Total consolidated reserves are 6 lakh rupees. And consolidated P&L here, what is the amount to be added? 11,500. I will add 11,500, which will give me total of 2,61,500 of P&L. Now, next point is finding your cost of control. We normally prepare one account. Which account? Cost of control account, wherein we'll see what is the value that we have invested, and against that value, what are the benefits that we received in the form of equity shares and reserves. Yes, this is my cost of control account. Now, but how much have you invested in this? To balance brought down, or you can call it as to investment. If you see your question, you have invested total 4 lakh rupees. And against this 4 lakh, what all things did you get? You got share in equity share capital of gamma. How much beta? 80% of 2 lakh 50,000, which will give you 2 lakh rupees. Then you got some share in pre-reserves of gamma. Come to my working note 1. Over here, how much am I supposed to add to cost of control? 50,000 rupees will be added to cost of control, whatever I am considering. I am circling it. What else do I have after working note 1? I have revaluation reserve. Again, over here, cost of control will include 90,000 rupees of revaluation reserve by pre-revaluation reserve of gamma. ₹90,000. After that, we found out our impact on depreciation, and for that I'll come over here. We have already considered this amount. Which amount are we supposed to consider now? 30,000, that will be transferred to cost of control by P&L of gamma, 30,000. So beta, what all things did you get? When you become the shareholder, you not only just get equity shares, but you even become owners of the reserves and surplus to the extent of the shareholding in your company. What is the shareholding percentage? 80. So we have calculated 80% of everything. So you got equity shares of 2 lakhs plus 50,000 of benefit of reserves plus 90,000 of revaluation reserve and 30,000 of P&L. Total value received is 370, but amount paid is 4 lakh, which gives you a balance over here of 30,000. Can I say you have paid extra? Why have you paid extra? You have paid extra towards goodwill. So this will appear in your consolidated balance sheet. Yes. Let us see if this value of goodwill is given. They have calculated it in point number 6, cost of control. 2,80,90, total 370. Yes, they have considered these items. 4 lakh is your value invested, therefore 3 lakhs are the balances that you have. Done beta? Acha. 30,000. They have showed this 30,000 under intangible assets. This is done. Let us see the remaining balances and complete the sum. Okay. Now, next balance which I want to find is minority interest. I am circling all the minority interest with red color pen. We will take our calci. Minority interest should get 12,500 rupees plus they should get this 25,000, which will give you 37,500 for reserves. Does minority interest have share in revaluation reserve? Yes, beta. They have share in all those items where Beta Limited has share, but only to the extent of 20%, 22,500 plus minority interest will get 10,375 for towards P&L. That will give you total 70,375, and at the end minority interest shall get what? It will get your basic equity capital. So have the working of minority interest be shown? Yes, point number 5. Beta Limited got 2 lakh rupees out of 250, so remaining 50,000 belongs to minority interest. 20,000, 22,500, 25,000 and 2,875. This will give you our balance of 1,20,375. We have calculated in our way. I just need to add 50 more thousand to it of share capital. I will get the same amount. Yes, beta. Presentation is different. Answers are same. We have completed minority interest. Where will you show this? In your balance sheet. 1,20,375. Let us first complete the amounts which are easy. Trade payables. Is there any change in trade payables? No. 3,75,000 plus 1,42,500 will give you your basic figure of 5,17,500. Property plant will change. So we'll wait for that. Other non-current assets, 11 lakh plus 3 lakh 75 will give you 14 lakh 75,000, and this 4 lakh has been transferred to cost of control, whose net effect has been provided as goodwill. So now, which points are pending? Only 2, reserves and your P&L account. Let us complete quickly our reserves. Okay. Total consolidated reserves will be mentioned over here. 6 lakh rupees plus 2,61,500. Yes, these two I will show first. 8,61,500. If you want, you can see your notes to accounts number 1. 5 lakh, 1 lakh, 6 lakhs. That is what we have showed. 2 lakh 50, 11,500, 261,500. We have shown the same calculation over here. Yes, beta, nothing different. Last will be your property, plant and machinery. Now beta, since we have considered revaluation reserve in our solution, I need to revalue my assets too. Tell me, what should be the value of my asset? Beta's asset will remain same. Beta's machinery will remain same as it is 7,50,000. They have shown total appreciation. You can directly take 3,75,000. That is your new value of machinery, and on that you will be charging depreciation at the rate of 10%, 37,500. You will get your new WDV. Similarly, furniture of Beta shall remain same, 375, as it is given in the balance sheet. Here they have showed the old value and revaluation reserve. Net amount is 37,500, which has been directly mentioned in the sum, and on that consider depreciation at the rate of 15%. You will get your WDV. This is your total value of asset. There is a printing mistake. Just add 5. Got it, beta? That is it. If I transfer these values over here, my balance sheet will tally at 29,99,375. All you have to do is rest all the assets and liabilities shall remain same. Property, plant and equipment will change and reserves have to be taken care of. All the reserves of Beta Limited will stay as it is. All the reserves of Gamma Limited shall be divided into three parts. So it will consist of pre-period profits which will be transferred to cost of control, post-period profits which will be added to consolidated reserves, that is to these balances of 5 lakhs of Beta Limited, and some portion will be for minority interest. This will be for the reserves given in our balance sheet, all the reserves, revaluation reserve, P&L, the normal general reserves, everything. Yes, beta. So this is it. These were your basic sums of RTP May 2022. After solving each and every sum and analyzing, we realized that the sums are actually manageable and not that challenging. Yes, you will be easily able to solve it if you focus properly and read the sums carefully. I hope you all very best from me and the entire JKSC team and hope to see you all in CA final. Yes, thank you so much. I hope you liked the video and you have understood everything. Thank you.